I guess it's closer to 75 than 100, but 100 is in play. November 36, and of course, those can change. Ksenia Galuchko joins us right now, Bloomberg equities editor out of London. Ksenia, how much has this impacted equities? Were people really expecting a pivot?
Oh, yes, they were. I mean, the rally we've seen over the past week clearly pointed to investors expecting a Fed pivot, but it is not going to happen, as we saw from this red-hot inflation data yesterday. And the market was in for a rude awakening. We saw the biggest drop in the S&P 500 and the NASDAQ since 2020. Pretty dramatic stuff. At the same time, keep in mind that, yes, the sell-off looked big, but it basically just reversed the rally that we've seen over the past week. And U.S. futures are actually ticking up higher today. So there might be a pause after the sell-off, despite all the rising risks.
Yeah, so the Nasdaq was down more than 5%, but look, it's up 0.6%. So, you know, we'll take that perhaps. Capitulation, are we there yet, Ksenia? What do the quants have to tell us?
Well, yes, so Bernstein has a very cool note out this morning saying that this U.S. bear market is hardly over. They're looking at the past bear markets in the S&P 500 going back to the 1930s, and they're saying that generally the bear market scope from peak to trough was 28%, while the past year's bear market that we've seen is just 20%. So they're saying that there's more pain to go for U.S. stocks, but in the longer term, they are bullish on the U.S. stock market, and they say that we're in for a rally over the next 12 months.
Okay, the wisdom of quants. Thank you very much, Ksenia Galuchko, joining us there with the latest on the markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of a solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
We will never break. We will never break. Build on a foundation strong enough to stay. We will never.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Now, keeping you up to date with news from around the world, here's the first word. In South Korea, an arrest warrant has been issued for the founder of Terraform Labs crypto ecosystem. Do Kwon and 5 others are accused of violating capital markets law. Terra imploded in May, sparking a global crypto rout. And Volkswagen has lined up commitments from anchor investors for its Porsche IPO, which could be one of...
In breaking news, oil prices are surging.
The world can be a noisy place.
Stock prices are set to soar.
But what if under all the noise was opportunity? Would you hear it? Would you see it? And if you did, would you take action? Join more than 3 million users in over 100 countries and be empowered with Capital.com.
One of Europe's largest ever. Bloomberg has learned that one of those investors is Norway's sovereign wealth fund. We'll have more on the markets next. This is Bloomberg.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person, I have to worry about my family, I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with their head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Wall Street debates the Fed's next move. Some traders argue in favor of a 100 basis point rate hike after an unexpectedly hot inflation report. Meanwhile, inflation in the UK eases from a 40-year high. More headaches for President Biden. The latest inflation data rocked markets and put a dampener on his celebration of the climate and tax law. Now the president is trying to avert a nationwide rail strike set for Thursday. And hard times for the big investment banks. They're forecasting big declines in fees for the current quarter as clients stay on the sidelines. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Matt, European equity markets, they followed the Fed south at the early part of the trading day, but we kind of priced in some of the selling from yesterday. But US futures look more buoyant this morning, and that's helped us turn around a bit.
Yeah, we are up in terms of U.S. futures, but after the monster drops that we saw yesterday, you would imagine a little bit of a bounce for this morning. So we were off more than 4% on the S&P yesterday, the biggest drop in 2 years. The NASDAQ was down more than 5%. As a result, not surprising to see a gain on futures of just about 2/3 of 1% right now. The U.S. 10-year yield just rocketed up yesterday, and it's held at those levels. So 343.52 is what we're looking at right now after investors just bounced out of that debt, worried that we would see 75 again, maybe even 100 at the next Fed meeting. Here's the Bloomberg Dollar Index. It's coming off a little bit, but still at 1305. So it soared as well after having come down earlier in the week. And Bitcoin right now holding steady at around 20,000. So even with the move in the dollar higher yesterday, we're coming down a little bit today, but the big bounce that we saw, Bitcoin hasn't been punished too terribly, still holding in the range that we've seen it. Kaylee, other currencies, if you consider that, are seeing bigger moves.
Yeah, and the yen is one today. We actually have some breaking news on that right now, Matt. Japan's Finance Minister Suzuki is saying they will take action immediately on the yen if needed, though they will not give a warning on intervention when we do it. Again, that is according to Finance Minister Suzuki. Right now, the Japanese yen trading just around that 143 handle, but of course that follows overnight the BOJ with those rates questions to players in the FX market, which is usually considered a precursor to intervention. So definitely a story we will continue to keep an eye on. Again, the Japanese yen trading at 143.41 at the moment. Let's turn now to some movers in pre-market trading, though. I really want to check on technology because it was in technology that you saw the brunt of the pain of yesterday's sell-off. We had stocks like Amazon, Alphabet, Apple, all down in the tune of 6 to 7%, but a rebound taking shape this morning with those stocks up just about 8 or 9/10%. So again, not enough to recover yesterday's losses, but still an upward move, and it's an upward move for Tesla as well. That stock up about 0.5% before the bell, Anna.
Kaylee, we see European stocks under a little bit of pressure this morning. We've been down more than this earlier on in the session, so paring those losses a little as we look at US futures and that small at the margin bounce that we're talking about this morning. The euro staging a little bit of a fight back. We saw, of course, incredible dollar strength yesterday, and the euro lost a lot of ground in that context. But today, just fighting back a touch, back over the $1 mark for the euro against the US dollar, so up around 0.4% on the euro. Inditex, 4.46% higher for this particular stock. Inditex is the owner of the Zara clothing chain, and they are having some success at passing on costs, better than some of the rivals in the fast fashion space, it would appear. They are managing to take those costs and pass them on with price rises bigger than the cost increases. Uniper is the German utility business, down 6.5%. It's been a volatile session for this business. We saw headlines earlier on today that talked about some of our reporting, in fact, talking about the possibility of nationalization of this gas supply business. But then the parent company of Uniper saying, well, hang on, conversations are still ongoing, and so the stock sold off, down by 6.5% right now then, Matt.
All right, let's talk about where these price drops put our valuations. Joining us now is Matt Maley, Chief Market Strategist at Miller Tabak. And Matt, I noticed in your note you were pointing to the fact that risk assets are still very expensive. So I looked into the Bloomberg terminal under the financial analysis page for the S&P 500. I see that we're currently at 19, a little more than 19 for price earnings. We were at 30 in 2020, so much higher, but in 2018 we were down at 1664. So we're still a lot higher than we were at the end of that slump in 2018. The same is true when you look at price to book. The same is true when you look at price to sales. Everywhere you look, we're valued at a lot more richly than we were in 2018. Does that make sense here?
And that's the problem we have, that because the Fed is really fighting two things they have two goals with their tightening policy. I mean, one, of course, is this inflation issue that we're all talking about every single day and should be. But they also have the situation where they have to, they keep talking about how they got to get things back in balance. Because remember, flooded the system with massive amounts of liquidity, kind of steroids, because of what happened in 2020 with the pandemic and the almost complete shutdown of the global economy. And so we kind of had this situation where we thought, okay, we'll get asset prices up here, and then eventually everything will catch up. The problem is we kept the asset that liquidity program going too long, and we could never really fully catch up in terms of the underlying economy. So it stayed too expensive, and we need to get it more back into balance. And so it's kind of a two-pronged attack right now.
Well, and of course, when we think about the expensiveness of the market and those stocks that command higher multiples, that's where you see the brunt of the impact of higher rates. And as I look at a 10-year real yield that is approaching a full % in positive territory, Matt, we've been dealing with negative real yields for so long. What influence is that going to have on the equity market and really across asset classes for that matter?
Well, Kaylee, as you say, with interest rates moving up, and we're now moving up towards that that June high of 3.5% or just under 3.5%, you get much higher than that. Again, on a technical basis, that brings in a lot of concerns in. But the key thing is that, again, it makes those valuation levels even more extreme, especially for some of the technology companies. These are the ones that we worry about the most. I mean, the one thing I guess that concerns me is that we saw in the spring, the market kind of rolled over, and then it was when the big cap tech names really started to roll over, in kind of a lagging effect. That's when the real decline took place. And that's what we're seeing again now. We've seen the market roll over a little bit over the last several weeks, and now the big tech stocks are starting to roll over. If that becomes a bigger problem because of those high interest rates, that's what's going to cause us to, I think, retest and even undercut those June lows.
Matt, our colleague Sonali Basak was on with us earlier and mentioned that there's only 16 days left of the quarter. It's already almost over, if you can believe that, which means another earnings season is coming in just a few weeks. Are expectations for corporate earnings still too high, the E part of that PE?
Exactly, that's one of the problems. The market is still a little still overvalued, and if earnings are going to come down, that's going to become even more overvalued. And one of the things we're going to be looking at today, we had CPI yesterday. Today we have the producer price index, and of course those are the the cost side of the input costs for companies. And if that's another high number, then that their input costs are really high. That's going to be harder to pass on to the consumer. They've been able to do it for a while now, but we see with consumer debt, credit card debts, rising again, they're not going to be able to pass those along as well. That means that earnings are going to kind of have to come down. And again, this kind of compounds the situation. I'm not looking for a repeat of 2008 here. I just think that the market still has further some more pain to go through, I'm afraid, and it's actually going to be a healthy thing in the long run, but a painful one in the short term.
Will this be a quarter, Matt, good to see you, will this be a quarter where we really discern between those companies that have the ability to pass on the costs and those that don't? Because, this might come down to the nature of your contracts with your suppliers and your customers and the level of flexibility that they contain. It might come down to the strength of your brand. Are we really going to start to discern between different types of business here?
Oh, I definitely think so, Anna. And I don't want to again overstate the negative issues here, but Warren Buffett used to say that it's when the tide goes out, we find out who's swimming naked, and that's what we usually see in the second leg of a bull market. It usually doesn't happen in the first leg. It's the second leg that some of these companies that have been struggling and haven't been able to pass things on, then they become more exposed, and they start to get to fall a lot more as well. So like I said, that old Warren Buffett saying is going to go well, not just for some investors who may be over leveraged, but also some companies that have been kind of hanging on by their fingernails. And I'm, again, not saying they're going to go out of business, but that their earnings are going to have to come down, and they're not doing as well as people had hoped they would.
I heard Anna this morning asking Grace Peters if we've seen capitulation yet. She said no. What do you think? Do we need to see capitulation, and how will we know when we see it? If yesterday wasn't that?
Yeah, the one part. Well, first of all, no, we don't always have to have it, but we usually do. And when people finally just said, "Get me out! I don't care any price, just get me out." And that, that's usually the best time to be buying. They say buy when there's blood in the streets, as the old saying used to go, or still goes. But no, I don't think we've seen it yet. Now, yes, we did. The breadth yesterday was incredible. It was 99. The advances versus decliners. When I say breadth, I say advances versus decliners was 99-1 negative for the S&P 500, and it was zero. There were zero stocks in the NDX, the NASDAQ 100, zero stocks rising yesterday. And so that when you get that really bad breadth, that's kind of an indication. But you also want to see the big volume. Yesterday's volume, the composite volume was still less than 4 billion shares. You want to see that up in 7 or 6, 7, or really 8 billion shares. And, we were nowhere near that, where we really showed that people panicked and decided to get out. So capitulation I see as, a really, really bad breath, but also a big jump in volume, and we haven't quite seen that yet.
Okay, we'll certainly watch for that. Matt Maley of Miller Tabak, thank you very much. I like the way that Gary Shilling described it to us earlier on this week. He said that investors have not yet reached the puke point where they regurgitate their last stock and swear to never buy another. And I apologise for anyone who's eating breakfast, which might be everybody stateside. Coming up on this programme, we will get a fixed income perspective on this. Guy Steer, head of fixed income research at SocGen, joins us. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
What do you think is happening in the blockchain industry right now?
I think in the long run, DeFi wins. DeFi wins because it's a better system. It's composable, it's transparent, it's cheaper because you're just code. You don't have all these people in this legacy infrastructure.
The core print for today was not fantastic.
I think markets overreacting to this.
Inflation is slowing down.
The cooling trend is there.
But not at the pace that the Fed is comfortable with.
The Fed isn't going to blink.
The Fed will now have more of reason to go 75 basis points next week, and I think that's what they'll do.
That number is going up, of course, with the November expectations rising as well.
Maybe 50 basis points.
75 is certainly going to be on the table there in November.
There clearly isn't going to be a pivot anytime soon.
The market's continuing to predict that pretty quickly the Fed does a pivot and starts to cut in the second half of next year. I think that needs to come off the table.
If today's data is any indication, they would probably hurry it up.
It puts the Fed into overdrive. And if they're in overdrive, sooner or later they're going to make a policy mistake.
Wall Street debating the Fed's next move following an unexpectedly hot CPI report. Joining us now is Guy Steer, head of fixed income research at SocGen. Guy, yesterday was a pretty remarkable day. Inflation far harder than expected, and you saw a real repricing in the bond market with the two-year yield now more than 300 basis points higher than it was when we started this year. As we look ahead to the Fed's meeting next week, is the move still 75 for you, or what probability would you put around 100?
Well, I'd say it's probably going to be 75. Yeah, I mean, I would say there's probably 80, 90% that'll be chance it'll be 75. I think the interesting thing is that the market is still expecting the peak of rates to come in March next year. And probably the bigger debate that should be taking place right now is whether we're not going to see we're not going to see a longer period of rate hikes, and we're not going to see a bigger plateau rather than starting to see rate cuts in the second half of next year, because inflation is proving stickier than people had expected.
Okay, so maybe a longer plateau to tackle that stickier inflation. Good to see you, Guy. And what about the arguments that the likes of Jeffrey Gundlach make, who say, they don't expect necessarily that the Fed will do 25, and certainly the market doesn't expect that broadly, but he makes the point that perhaps at some point the Fed needs to dial things back, not because they've reached their goal, but because they've done so much so quickly that there's a sense that maybe they need to pause to see what they've managed to achieve already. Is there any argument behind that, Guy?
I think the big problem is that if you apply a Taylor rule, or you look at what rate expectations are, people are expecting them to dial back fairly quickly, to accelerate early on and then dial back fairly quickly. And I don't think that's the way it's going to play out. I think they're going to keep hiking interest rates at fairly big chunks until they really start to see core inflation begin to decline. And if you look at the figures that we've had, you look at the median level of inflation amongst the components, there isn't really any sense that even that the peak has been passed, and certainly in terms of the sticky components of inflation actually coming down. So no, I would say that would be, and we're not even hearing that from any central bank at the moment. They're going to continue to be aggressive.
Yeah, I mean, I was looking at a chart that Valerie Teitel put together for us out of London this morning on rents, and it's just the biggest problem, right? The stickiest piece. I think the chart number is 3328 if you want to pull it up at home, or if we want to pull it up in the control room, 3328. As this continues to accelerate, I see your point that maybe March won't be the peak. Thank you very much. There's the chart. What's your terminal rate expectation?
Well, that's a good question. I mean, I think it really depends on what the inflation expectations are. Our economists are talking about now inflation of 4.3% over the course of 2023. Typically, what the Fed has to do is get rates above where inflation is in order to actually start stabilizing it and bringing it down. So the market expectations now of somewhere between 425 and 450, that seems really like the low end of what you could reasonably expect. It wouldn't be out of the ballpark to say we could return to the 5% peak that we had in 2005, 2006 before things are demonstrably beginning to reverse.
Okay, so 5. But Mark Mobius was telling our colleagues earlier on, Guy, that he thought maybe 9. I mean, reflecting on how high inflation is and what you just said there about the need to get rates higher than inflation, you still can't get to those kind of numbers, though.
Well, I think, no, 9 seems a bit aggressive. What you'd have to say is that it isn't, core inflation is really going to continue to accelerate. Leave aside the froth numbers, core inflation is going to continue to accelerate. Core inflation is going to end up at 7-8%. Then you would say they're going to have to bring it to 9. But I think now 9% doesn't seem reasonable now.
And finally, Guy, if we could just look across the Atlantic, in the UK, inflation actually came in just a little bit cooler today than expected, coming down from that 40-year high. But as you look at that and the potential fiscal policy coming out after the mourning period from Liz Truss's new government and what she has proposed as prime minister, how do you factor that into your view on gilts?
Well, I think it's hard to be optimistic. I mean, the big problem is that sterling has dropped 17% over the past year. That means that there's a lot of imported inflation. We can just see in terms of all the stories about hotel prices rising dramatically over the course of this week in September, that probably we're going to have a blip up in terms of inflation in September. I think this is the most difficult, the most negative asset class in terms of fixed income at the moment.
Guy, thanks so much. Thanks for joining us. Thanks to Guy Steer of Societe Generale giving us his thoughts on fixed income markets right now. Coming up on the programme, Shake Shack's digital transformation, how the fast casual dining chain adapted with the pandemic. More from our interview with the company's CFO next. This is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
The world can be a noisy place.
Stock prices are set to soar.
But what if under all the noise was opportunity? Join more than 3 million users in over 100 countries and be empowered with Capital.com.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. Now, the CFO at Shake Shack, Katie Fogarty, has an unusual background for that job, coming to the C-suite of a restaurant chain from Wall Street, where she was an analyst for Goldman Sachs. Her experience analyzing data is serving her well as the restaurant chain navigates through the pandemic and beyond. In the latest episode of Bloomberg's Chief Future Officer, Fogarty tells me how she's unlocking Shake Shack's digital potential.
It's amazing to sit here and think that this is a company that had essentially hardly any digital sales prior to the pandemic. And when the pandemic hit, we went full force on digital with the app, web, with third-party delivery. And here we are now with 43% of our sales still coming from digital channels, even as our in-Shack business has doubled.
And that doesn't count the kiosks, right?
That does not count the kiosk.
So what kind of investment was that? Was it a home run? Is that something where you're like, Randy, this paid off big time?
Well, it's something that we continue to invest in, and we continue to see opportunities to improve our app, improve that guest experience, improve the ways that we're incentivizing our guests to really lean into our digital channels. If you simply kind of look at what the higher frequency we get from those digital guests, moving more and more of them into the channels and continuing to invest to drive frequency of that base, it's a really good recipe for strong long-term traffic growth.
You can watch my full interview with Shake Shack's CFO on Chief Future Officer tonight at 9:30 in New York. And I have to say, I was able to go down to their headquarters in Lower Manhattan and taste some of the burgers that they experiment with. And I'm already a huge fan, but I'm an even bigger fan now. Anna, I mean, what's your favorite Shake Shack burger?
Oh, stop. You know that's mean, because we established in the break that I was not familiar with this.
How could you
I haven't
how could you not have been to Shake Shack? They have one in Heathrow. It's delicious. You should try it.
Other burgers are available, apparently, Matt. I just think you just did look as if you really enjoyed that assignment. Maybe just coming with lunch. It helps.
I am a huge fan, especially of the condiments. Kaylee, do you?
Yeah.
Do you indulge?
I enjoy a good Shake Shack burger and the fries. I really judge restaurant chains on how good their fries are, and Shake Shacks are excellent, I must say. And Matt, I wonder if this is like the equivalent of Anna in her former life as an airlines analyst becoming a CFO of an airline. That's essentially the path she took to the C-suite. I think that in and of itself, her career trajectory is really interesting.
Yeah, absolutely. I mean, going over to the light side, it would seem. So Really interesting stuff. Highly recommend checking out the program. Obviously, our viewers are going to be glued to the screen over the next few hours to see what kind of bounce we get after the huge drops that we saw yesterday. I mean, the biggest dips for equity indexes in 2 years after it looks like, Anna, did the market finally get it, re the Fed?
Right, well, maybe. But then we've asked these guests today on this program and on radio earlier and on my earlier TV show, are we at capitulation, 5% down on the NASDAQ? And no, a lot of people seem to say no, not yet, Kaylee.
Yeah, it's a question of how much further we have to go. I mean, you've had the bears out there, the likes of Mike Wilson at Morgan Stanley, saying all year long that we haven't seen the lows yet, that things are going to deteriorate. And I wonder how much that really is dependent on Fed policy and whether or not the market believes how hawkish Jerome Powell and co are going to be, and then whether or not the earnings with PPI coming up later today and the margin pressure in that Matt Maley was talking about, maybe we need a repricing on earnings expectations as well.
Yeah, I mean, Anna, you were talking about Gary Schilling, who was on with us earlier in the week, saying this market hasn't really puked yet. I can't remember the entire quote, but it was very graphic. In any case, he was saying you typically fall 40% from the high, and the high that we had in January was almost 4,800, and that means his target is for a drop to 2,880 on the S&P 500.
Okay, yeah, I can't remember the full quote either, but it was very vivid and best left to periods of the day that don't accompany breakfast. That is it for Early Edition. More surveillance is ahead. This is Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And frankly, when people leave 23andMe, I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. I want to build out a true consumer-empowered healthcare world, one that is outside of the existing system. And there's no greater force than government.
From New York City.
We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
To recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
What do you think is happening in the blockchain industry right now?
I think in the long run, DeFi wins. DeFi wins because it's a better system. It's composable, it's transparent, it's cheaper because you're just code. You don't have all these people in this legacy infrastructure.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
There are several pockets of this country that are still suffering from elevated inflation.
We know the Fed is going to slow it. The Fed has to slow it. We just have to debate how much above 4% they have to go to slow it.
It really is 2023 where you look for inflation to come off further.
If there's any doubt at all about 75, they're definitely going 75.
The Fed is probably going to overdo it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
What a brutal session that was. Live from London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures bouncing back just a little bit, but TK yesterday, the biggest one-day drop on the S&P going all the way back to 2020.
Yeah, back to the pandemic and all that, but more importantly on a scale basis, let's call it the 9th worst drop in history. What I would say, John, is on a red zone, green zone basis, it was a reset, and maybe it is reset Wednesday. But far more than that, John, is the way we closed yesterday afternoon in New York. There was no sense there of catching a bid.
Almost closed at the lows yesterday's session, Tom. Lisa, yields higher, much, much higher. It introduced some uncertainty, not about next week, I'd argue. It introduced certainty about next week. It's a much bigger move. Uncertainty about what would follow in November and after that, and whether this Fed is going to have to go a whole lot bigger for a whole lot longer.
What you saw is all of a sudden people pricing in a likelihood of a 100 basis point rate hike come next week.
Nomura.
And then Nomura is saying that that's the base case. In markets, about a 1 in 3 chance.
Anybody else joining them?
Well, it's a 1 in 3 chance currently being priced into the market that we will get a full 1 percentage point rate hike, even though that has not been on the table previously, and then a 75 basis point rate hike at the following meeting. What does that do in terms of changing the equation for a hard landing? And I think that is really what we felt. The economic
yesterday
pain
was
being
soft
priced
landing
in.
Tuesday.
That was the morning, Tom.
Okay,
Then we have the inflation report. And to Lisa's point, it's increased the odds the Fed needs to go bigger, which increases the odds and introduces this idea that they have to do more damage to the economy to get inflation down. Diane Swank was out on Twitter just yesterday, raising the likelihood that you might have to take unemployment above 5 to get inflation somewhere closer to 2.
Moment of silence. El Arian, Summers, Hollenhorst,
just
Anna
fantastic.
Wong of Bloomberg. Boy, they nailed it. They nailed it.
Are we done with the moment of silence?
Yeah, we're done with the moment.
But I was going to say that actually talking of Larry Summers, he came out and he actually supported a 100 basis point rate hike as well.
I missed that.
And you saw Jeff Gundlach push against that and say, actually, they should go 25 basis points because they're overdoing it. So, there still is this
Well, we saw that in the opening. I mean, the distinction yesterday between Mark Cabana of Bank of America and others was remarkable.
Mark Cabana of Bank of America, bear in mind Mike Gapen over at Bank of America is looking for a recession next year. Mark Cabana essentially said the Fed is going to overdo it. And what happened yesterday was an inflation print that will encourage the Fed to overdo it.
Yeah, and at a certain point, isn't it by design, right? What does it mean to not overdo it if they're trying to get the unemployment rate up? Right? So where are we talking here in terms of what's an acceptable amount of pain and what's an unacceptable amount of pain? And when does it just become a political issue where they have to respond?
Have you got used to a 2-year that looks like 370? 380 even.
Almost 380.
Oof.
Yeah, well, at what point does it get back to 4% if that's where we think that the Fed funds rate is going to be?
Futures with a small bounce this morning. Good morning to you. I'll whip through the price action just briefly. We're positive by about 0.5% on the S&P 500. Euro showing a bit of strength, just about parity on euro dollar. Yields higher, much, much higher. And we add some, up another 2 basis points on a 10-year. Lisa, 343.33.
All right, so today is not PPI Wednesday. I'm just going to say that. We are getting at 8:30 a.m. Eastern Time, U.S. August PPI, producer price index for price. Well, it is technically, but do we care? And the only way that we will actually care about this number, and this is my editorializing here, is if it comes in more hawkish or hotter than we expected, because then it will fit into the narrative that we heard yesterday. If it comes in weaker, does it really move the dial? I don't think so.
It's hot in here, isn't it?
It is hotter than we had expected in here. At 10:30 a.m., we get the EIA crude oil inventory report, getting the latest read on the U.S. inventories of oil and gasoline. I am curious to see whether we actually are seeing a real fall off in demand, if that's really the story here, or if it has been just an SPR release full and through and through. And then today, just sort of moving into this question about COVID zero. China's President Xi Jinping is beginning a 3-day travel, the first since the pandemic hit, abroad. And he's going to be in Central Asia, and he's going to meet with Vladimir Putin. And I find this really interesting because it comes at a lot of talk about whether they're going to continue zero COVID. Does it signal anything that he's leaving the country?
A foreign trip.
She's really read in this
There we
morning.
go. That's a good thing.
It's a good. You and I were out having Vindaloo last night, and she was home reading.
We were working out whether we should bring on a bull or a bear or someone who was
Let's
just
do both.
someone who was just right. Let's get to someone who was just right. Max Kentner, Chief Multi-Asset Strategist at HSBC. Max, we all read your note. Max underweight. Now, you can tell me what that means in a moment, but you have not been constructive on this market, and I imagine you're still not constructive on this market.
Not particularly, no. I think, if anything, if we look at the number yesterday, right, that strengthens this kind of positioning, unfortunately. So I'm delighted to see that you three are still very upbeat whilst talking bearish. I'm not doing as good a job. I'm dragging myself down, so I'm not sure whether, at the end of this section we're all going to, feel a bit more bearish, perhaps even more. Look, I guess the point really that I would make is it's not really about whether we're going to get 75 or 100 in September. What it's about, I think, if we look a little bit ahead, right, it's about we all sort of thought, okay, it's going to be 75 or 50 or 75, then it's going to be 25, and then it's going to be 0, and then they're done, and da-da-da, right? The point now that what the number does yesterday is perhaps opening the door, at least to market pricing, not that the Fed has to do it, but to market pricing in the following meetings to say, actually, are we really need 25 basis point steps, or do we need to continue doing 50, or maybe continue doing 75, right, for the next 3, 4, 5 months? So where's the valuation support going to come from? It's just simply not there. Right?
Do those rate increases diminish demand?
Not yet, right? That's the big issue,
yet,
right?
But
Not yet.
What's HSBC's, and particularly with your Asian perspective, when does demand actually get diminished, according to a textbook everybody forgot years ago?
Yeah, I guess that's the big issue at the moment, because it does take time, right? It does take time. When you look at all of our models are basically saying, look, we had an inventory overhang that's now feeding through into manufacturing PMIs. Now we're starting to see housing weak. That takes around 3 to 5 quarters until it feeds through into the labor market, right? That then feeds into sort of forward-looking consumer data. So we're then talking about well into 2023 for that weakness. That's the big issue, right? And the big issue with demand now is that whether demand craters or not doesn't really matter, right? Because you got 2 scenarios. You have the scenario where already now demand is getting destroyed. So earnings expectations, growth expectations will be proved to be way to be bullish, right? And that's bearish. Or on the other hand, you say, well, actually, it's not happening yet, right? But that means we're going to get further. And that means it comes from valuation.
Is this a bad news interview?
I think this is a bad news interview.
Well,
that's any news is bad news.
But it's good news that we have you on and to talk about what that translates into what you actually are buying. And you were talking about how if you start buying anything other than crawling just into a bunker, it will be developed market sovereign debt. Are we there yet? When do you see the value in some of the yields where we're seeing them get to?
Yeah, I guess, so first one, what would we do right now, right? What you do right now in an environment where real rates go up and break-evens go down, what you do is you go into the dollar. What you actually find is that bonds don't do well, right? Equities don't do well. You can't do an awful lot of relative value trades. Credit doesn't do well. EM doesn't do well. High beta FX doesn't do well. Nothing does well apart from the dollar, right? So you go into the dollar, you go into floating rate notes, you go into short-dated credit, you go value over growth, those sort of shorter duration trades. That's what you do right now. The signal that I'm waiting for, perhaps for developed market sovereigns, now, if I was a classic strategist, which obviously I am, is, I would probably say, well, if the market at some point is more convinced that growth is really going down, but that doesn't help us. I think the signal, the market signal we want to look out for is if the dollar goes up and the yen goes up simultaneously, because what that means is that it's big-time recession fears that are now taking over.
Okay, I'm so glad you brought up the currency and the dollar. We heard some job owning overnight. We heard an attempt by the People's Bank of China to try to strengthen with the peg that was the strongest ever relative to where it had been. But really, it was the Bank of Japan saying, we're going to do something, and we're not going to announce when, and we're going to come out, and you guys watch out, but we're going to intervene, maybe, even though we don't know.
It doesn't sound like you believe them at all.
Well, I mean, we don't know anything. So do you lean against the dollar trade? Do you lean into the yen because you're just convinced they will actually do something?
Not yet, right? I think that could be the case for, later in the year perhaps. But the problem now is, imagine if they did some intervention already now into perhaps a 100 basis point FOMC meeting. Imagine they do 100.
Sure.
Right? Imagine they do that. Then they had this one silver bullet that they fired for nothing. So you don't lean into that just quite yet. I think that's going to be something for later in the year. But if and when it happens, right, yen up and dollar up, it means big safe haven flows, big safe haven demand. Why? Because then the market is really concerned about recession. That's when you go into developed market sovereigns.
Let's talk about another signal. You've been bearish all year. What would make you bullish this equity market?
Nothing, ever. I'm German. So there's nothing that can make me ever bullish, right? No, in all seriousness, I think that there is a couple of things, right? When we look at China's credit impulse, for example, that is already rebounding a little bit, right? So that perhaps at the beginning of 2023 could be giving us a bit of cyclical tailwinds. There is other things like sentiment and positioning, right? Sentiment and positioning on our measures was around about 8th, 9th percentile, and in the middle of June. Right? That, however, now is around 40th percentile on our measures. So we're not quite there yet. But if really sentiment and positioning, following from yesterday's drop, is going towards 10th percentile again, actually that plays very much into the bull's hands.
Max Kettner, thank you, of HSBC. Good friend of Lisa's. You will not be surprised by that. Tom, that was incredibly bearish, wasn't it?
I'm depressed.
It was realistic, and he said it so cheerfully.
Well, he's been right.
He has
year.
been right.
Let's be clear about that.
Yes, and this comes from the camp that has been bullish on treasuries for years when everybody else was leaning against them and has gotten it right. So that's the Stephen Major camp over at HSBC that Max Kettner belongs to.
What were you thinking about that Japan call?
What do you think that I was thinking? I mean, it's just amazing to me. How long can they jawbone before actually doing something?
Sure. Tom, it's got to be about policy, the doing, and not words.
Well, policy and also politics. I would suggest nothing happens in Japan until after the funeral for the Queen. The Emperor of Japan will travel here. There's no way they're going to do anything with the Emperor traveling. No way.
We'll catch up with Wei Li of BlackRock on the equity market situation. It was brutal yesterday. We're bouncing back just a little bit right now. Equity futures positive, 0.5%. Live from London. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. European Commission President Ursula von der Leyen will call for radical steps today to stem the energy crisis. That will edge closer to rationing measures and higher taxes on energy companies. The key question is whether von der Leyen's proposal for a 5% reduction in gas consumption survives various negotiations. In the UK, inflation has gone down slightly from its highest rate in 4 decades. The Consumer Price Index rose 9.9% last month from a year ago, a drop from 10.1% in July. Now that reflects an almost 11% decline in the cost of gasoline. Bank of England policymakers meet next week. They're expected to raise interest rates, either 50 or 75 basis points. The Biden administration considering whether to replenish the Strategic Petroleum Reserve when oil goes below $80 a barrel. Just 2 years ago, Democrats blocked former President Trump from filing a reserve at a fraction of that price. Senate Democratic leader Chuck Schumer called the Trump proposal a bailout for big oil. That cost the U.S. billions in potential profits. A strike set for Friday could prevent American railroads from transporting farm products and other key goods. It could cost the U.S. economy $2 billion a day. President Biden is personally trying to break the logjam between railroads and labor unions. Labor Secretary Marty Walsh will meet with railroad and union representatives today. And Queen Elizabeth II's coffin is now at Buckingham Palace. Today, there will be a procession through London to Westminster Hall, where she will lie in state for 4 days before her funeral. Members of the public will be able to pay their respects 24 hours a day. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
the price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad, and crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg Terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short term.
Bloomberg Markets, The Close, weekdays on Bloomberg. From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We will never break. We will never break. Build on a foundation strong enough to stay. We will never.
When U.S. inflation numbers are released,
A stunning inflation report.
Bloomberg brings you crucial data at terminal speed.
Core rises 0.6%. That is double last month.
And instant expert analysis.
There goes Goldilocks.
Republicans are really going to harp on that. This is about a narrative shift in markets.
There clearly isn't going to be a pivot anytime soon.
Sooner or later, they're going to make a policy mistake.
Ouch for America, but double ouch the rest of the world.
Nobody covers the economy like Bloomberg, your global business authority.
In these times, it is wrong to receive extraordinary record revenues and profits benefiting from war and on the back of our consumers. And overall, our proposal will raise more than 140 billion euros for member states to cushion the blow directly.
A target on the back of energy producers, energy companies. Ursula von der Leyen there, the EU Commission President, live from London this morning. Good morning to you. Yesterday, absolutely brutal. Futures right now bouncing back on the S&P 500, positive by 0.6%. This equity market, a 4-day rally, amounted to about 5% higher on the S&P, colliding with a hotter than expected inflation print, and the equity market gap lower. Yesterday, Bramo was, shall I use that word again? Brutal?
Yeah, please.
It was ugly. It was ugly.
It basically erased the rally that you'd seen over the 4 previous days to give you a sense of the brutality of the losses.
Brutal.
I'm trying.
I know. You always seem happy about it, which is concerning.
No, I'm not happy about it. I'm just explaining.
Just wind you up a little bit. Yields up too.
It worked.
Tom, yields higher.
Yeah, and the key phrase there is 4 days. that we gave up 4 days or 4 weeks or whatever on a long-term basis is just more of a volatile inflation churn. Someone like David Rosenberg, expert on inflation, says you never can predict what it can be. What I would say, John, the number one research item I saw was a single sentence: the necessities showed sticky inflation. To me, that was the story.
And that fueled the number one theme for me, Tom, in the Southside research yesterday off the back of this, is the step down the equity market bulls were looking for from 75 to 50 to 25. Some big questions about that now, about whether the Fed can actually deliver that step down, that sequence over the next few meetings.
We're excited about our Fed show next Wednesday. Really looking forward to that back in New York. Right now, we're excited about Anne-Marie Horton in Washington. And joining us from Strasbourg, France, there's always a reason to be in Strasbourg, for Maria Tadeo. Maria Tadeo, what is the attendance of Mr. Putin at these meetings of European leaders? What is the Putin effect this morning?
Well, Tom, I think the effect here is that he has created or has seen the start here in Europe of a war economy. I think that when you look at the language from the head of the Commission, that is what's in store for the European economy. She talks now about demand destruction that becomes mandatory. She talks about solidarity from companies. She talks about sanctions that will stay on. She was also very defiant. I think if you move away just from the details of the energy, the market really cares about this. But to me, the bigger point is the fact that today she made it clear the sanctions are going to stay on. And she had a line here, which to me was the key. She said, Vladimir Putin is waging war in Ukraine, but he's also doing that on the European welfare, on the European market, on our economic stability. And this is something that's now a fight between autocracy and democracy. So if you ask me what's the Putin effect, I think it's a war economy for Europe.
Right. Maria Tadeo, the great historian Steven Sestanovich, who's helped us so many times here on surveillance, tweets out today and writes in the Daily Beast of Putin wanted to be Peter the Great, but Putin maybe being more like Milosevic of another decade in the recent history. Have things changed at the dialogue at these meetings because of what's happened in Ukraine in the last 48 or 72 hours?
Well, it has, and it has to do with the Ukrainian army and the advances that they made on Saturday. And I know we talk about this all the time, and I go on and on about this, but the conversation in Russia has really shifted over the past 3 days. I was struck when on Russian television yesterday, someone went, perhaps we should stop saying that Ukrainians don't exist, that Ukraine is a fake country. There's a huge debate in the country about should we now declare a full war? Is this conscription? But as always, and this is the point, if you're a Russian man, you're underpaid, you've been to military training for a month, and you've been watching a war like it's reality TV. Do you really want to go to Donetsk and fight Ukrainians who up until a year ago were your Slavic brothers in the name of Vladimir Putin? I think that's a real question, and that's why he's shielded the Russian population so much from the war on a daily basis. Can he sustain that? That's a real question.
And we've been talking about how even if the conflict does end, or even if Ukraine does make a lot of inroads, it's not going to change the policy. And Anne-Marie, it's really raised some questions as the energy crisis moves global into how to shore up prices for consumers while encouraging fossil fuel companies to invest. And I wonder how much that was behind the story that you reported on yesterday, breaking the news that the White House is looking at buying oil when it reaches $80 a barrel to refill the Strategic Petroleum Reserve.
Yeah, it would have to dip below $80 a barrel, I think, for them to really be able to go after this and do this. But part of the problem they have is that, yes, they were able this summer. They worked really hard with their messaging with this Strategic Petroleum Reserve releases we've seen. Last week, by the way, was the biggest release ever on record. And right now, when you look at the SPR inventories, they're the lowest they've been since 1984. So they're thinking about how do we put some stock back into it and entice really the Permian Basin. And Javier Blas was writing about this just this week, the fact that there's a deceleration in rigs, there's a deceleration in growth in the Permian Basin, and that is what is really going to be relied upon if you are concerned and you are a U.S. official about potential oil price spikes in the winter when Europe and these sanctions come into play in terms of blocking off Russian crude, if there is no oil price cap the way they envision it. So they're really trying to make sure they can do a number of things at all fronts. They obviously would want lower prices for consumers, and obviously inflation is one of their biggest headwinds going to the midterm elections. At the same time, they want to make sure that they are enticing these fossil fuel producers and giving them a little bit of a pat on the back to make sure that they continue that investment, because of course a lot of these shale producers need a higher break-even point. It's also interesting all of this comes on the day, not just after the inflation report, but today the president will be going to Detroit to talk about electric vehicles.
AMH, just briefly, can you walk us through how bizarre yesterday was to see the equity market down by 3-4%, to see inflation come in hot and the president almost do some kind of victory lap for the Inflation Reduction Act?
It was a pretty odd moment at the White House. You have hundreds of people there, and someone looked at me and said, this feels like a concert. And it did feel like a concert because there were performances there. And the president, even though he was talking about the Inflation Reduction Act, he did start by saying this is something I wanted to do when I entered office. So almost admitting that the name Inflation Reduction Act was obviously political spin, and this really was just a smaller version of the Build Back Better plan. But he completely ignored the data. There was no mention of yesterday's worse than expected inflation report at this event. And this was what Republicans really harped on, with Senator Mitch McConnell saying that the Democrats yesterday were, his words, tone deaf.
A strange moment. AMH, great reporting, by the way, down in Washington alongside Maria Tadeo of Bloomberg. Lisa, a rather strange moment in D.C.
Yeah, especially because it was just an incoherent report.
What do you think is happening in the blockchain industry right now?
I think in the long run, DeFi wins. DeFi wins because it's a better system. It's composable, it's transparent, it's cheaper because you're just code. You don't have all these people in this legacy infrastructure.
And you're seeing people double down on their message. It's not just the White House. We're hearing that around.
That's what politicians worldwide do, right? Futures, positive 0.5%. That was almost diplomatic. This is Bloomberg.
Almost.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
Live from London this morning. Good morning. Equity futures pushing higher by 0.5% on the S&P 500. Yesterday, the biggest one-day drop on the S&P, going all the way back to the summer of 2020. That's how big the losses were on the S&P 500. Futures bouncing back just a little bit. Yields are higher again, though, by 2 basis points on a 10-year to 343.33. Your two-year still through 370. And Lisa, seemingly at one point yesterday, it felt like we were going through 380.
It felt like people just basically were going to go straight to 4% and keep it there because that seemed to be what the Fed was signaling. And finally, the market seems to be catching up.
Just a little bit, Tom, catching up and questioning, not next week, 75 for many, perhaps even bigger if you're listening to Nomura. But it's beyond that. November, Max Kettner with us about 30 minutes ago, talking about the need, perhaps the willingness of this Fed to go further. And then we have to think about the consequences of that, the damage that it will do to this economy to get inflation lower.
I would make it global, and the day after the Fed meeting is suddenly important, as you saw sterling at 114.57 in the shock yesterday. Can you imagine a 113 sterling?
Yeah, and can you imagine a 75 basis point hike from then as well?
No, I cannot. As an amateur, I cannot.
We had it from the ECB.
We'll listen to our pros.
We're going to get it from the Fed potentially, and it looks like perhaps the Bank of England might follow.
We speak of economics, finance, and investment, but right now we turn our attention to a path to Monday and the funeral of the Queen. Lizzie Bird, an expert on this, is at one of the most historic parks over Westminster, Abington Green, next to the Jewel Tower, and off her right shoulder, Westminster Hall. Lizzie, tell us about the path from Buckingham Palace to Westminster Hall this day.
Tom, I have to say, there's a helicopter flying overhead, but apart from that, it's eerily quiet here in Westminster, and it's a reminder of the loss of someone who was above politics. Later today, the Queen's coffin is going to travel from Buckingham Palace through the streets of central London, which are closed now, to the Palace of Westminster behind me. And it's going to be a really poignant moment because her children and grandchildren are going to follow on foot. And it will remind many Britons of the moment 25 years ago when Princes Harry and William followed their mother's coffin. You're going to hear the guns fire in Hyde Park, the bells toll in Big Ben. And from the moment the Queen, the coffin arrives at the Palace of Westminster behind me until the funeral, she's going to lie in state on Monday, and people will be able to file past it and pay their respects. You've already had people queuing overnight despite the rain, despite the warnings that it could be 30 hours that they have to wait. Remember, in 2002, 200,000 people paid their respects to the Queen Mother in that way. And so this is likely to be beyond that, an outpouring of national grief, the scale of which we've never seen before.
Lizzie, tell us about the funeral on Monday. I was stunned to see that the Emperor of Japan will attend, but this will be a gathering of world leaders. Who else will attend?
Yes, the capacity of the Abbey is 2,000, and it will be heads of state, royals, dignitaries from all different countries, not notably Russia and Belarus. The invitation hasn't been extended, although Vladimir Putin has said that he wouldn't have accepted it. Volodymyr Zelensky as well has sent a message of condolence, but of course we'll have to continue with the war efforts in Ukraine. But it's also going to be a bit of a logistical nightmare. There are reports in the UK press that these dignitaries, heads of state, will have to come on buses because they won't be allowed to come on their helicopters and private jets. So it really is something that has been years in the planning, but it's almost impossible to plan for.
Lizzie, thank you. It's going to be a deeply emotional morning for a lot of people, and those events, Tom, will take place in the next couple of hours. Typically, that walk from Buckingham Palace down the Mall towards Horse Guards Parade and then across through Whitehall and onto Westminster perhaps would take on foot 15 minutes or so, Tom. This procession could take something like 40 minutes.
They speak, which I find unimaginable, a 1 hour service, John, maybe an hour and 15 minutes. That just seems to me just not doable. It's got to be longer.
Lizzie talked about the wait there for people lining up to see the Queen line
already.
of state over the next 4 or 5 days. Lisa, the waiting time, 30 hours. And by the way, you don't hold your position. You have to keep on moving. Can you imagine doing that for more than 24 hours?
Well, it speaks to the emotion. And I have to be honest, I have been surprised as an American in London how many people continue tearing up or call their parents and are very deeply emotional about how close they felt to the Queen and the loss that they feel.
And some of that will be from the House of Lords. We've been advantaged by Lord O'Neill, of course, with Goldman Sachs for years, or Lord Stern with his environmental effort for the United Kingdom. And then there's Meghdad Desai. He's Professor Emeritus of London School of Economics, but that barely captures his contribution to Indian society in his United Kingdom. He joins us today from India. Lord Desai, what does Prince Charles need to do forward to coalesce the United Kingdom across many religions and many ethnicities?
I think, in a sense, his mother has done that job. She has left behind a very stable, multiracial and multi-religious community. I think, in a sense, she did it by not playing a religious card too strongly, but sort of quietly and steadily. Yes, she is an Anglican and she played that thing. Prince Charles had said sometime in the past that he wanted to change his oath from being defender of the faith to defender of faiths, i.e. to include every religion. I hope he doesn't do anything like that. His main job is to keep quiet and play it straight as his mother did, and just let everybody rely on the things they have done very well all the time. My main fear is that he may try to innovate too much too soon, and that may upset the cart a little bit. But I think, in a sense, the economy is difficult enough, and I think we ought not to disturb the political balance too much either. So I'm hoping that he will put aside his strong opinions and just govern quietly.
Lord Desai, I'm curious your vision for the Commonwealth going forward, considering some of the discussion since the Queen's death that she was in some ways the end of an era. Do you think that the era that comes looks very different from the era of which she oversaw, which changed dramatically under her tenure?
I do, and I have said so in the House of Lords, because I think the time had come towards the last years of the Queen's rule to share the responsibility of heading the Commonwealth with other Commonwealth countries. But she, at the last Commonwealth Heads of Government meeting in London about 4 or 5 years ago, proposed that Prince of Wales Charles, as he then was, should be the head of the Commonwealth after her. So she closed that door. I think so. We have some very powerful Commonwealth countries. Some, as it were, hoping to be republics and so on. That is not a problem. But India is a republic and it's still in the Commonwealth. India actually pioneered that solution. But I think it's very, very important that Prince Charles takes into confidence the leaders of the Commonwealth, because they are now substantial countries. India is the fifth richest in terms of total GDP, and there are other powerful countries like Nigeria, and I think he will have to slightly balance it away from the overwhelming importance of the UK as head of the Commonwealth. I think it will require some diplomatic skill on its part, or at least good advice from the Prime Minister.
Thank you for being with us, sir. We appreciate your input on an important day for this country. Those events that we've been describing in the last 5 or 10 minutes, they're going to start at about 9:20 Eastern time. We'll catch up with Guy Johnson and Lizzie Burden to guide you through some of those movements, that sequence as the Queen goes from Buckingham Palace onto Westminster Hall. We also need to talk about this market, front and centre for a programme like this one. Equity futures are bouncing back, but yesterday it was brutal, and that's a word you're going to hear a lot from Lisa and I, and perhaps Tom, through much of this morning. Down 3 or 4 percentage points, and a big, big move through the bond market. 10-year yields much higher, the 2-year absolutely surging as we start to re-engage with the idea that this Fed is not done, and Lisa, they're going to have to do a whole lot more.
What I thought was interesting was that actually longer-term inflation expectations fell yesterday. And the question is not the credibility of the Fed anymore. The question isn't whether we eventually will go back to an era where we will see inflation under control. It's what's required to get there. And the pain changed. The pain factor yesterday changed, at least the perception of it, in markets. And that, I thought, was the most notable shift. Not just where the destination was, but how rough the path is going to be to get there.
They don't just want to beat it down, they want to bury it.
Right.
And to bury it, they've got to keep rates higher for longer. That's what they've been communicating. I mean, Tom, what's bizarre about this moment is that for the Fed chair, he doesn't need to change the script based on what happened with the CPI print yesterday.
Correct.
He just has to repeat what he's been saying over the last month.
We're using an analog to Paul Volcker, and it doesn't work. At that time, we had 10, 11, 12, 14% interest rates. It was a completely different environment. I take real issue with the compare back to Volcker, given where we are. With that said, they've got to use the x-axis, which means they have to articulate their path into 2023. And I'm in the camp, there's way too much communication. There's way too many interviews with John Farrow from President this and President that. He's got to get out and articulate the message.
Is that the promo for our Fed interview?
It is a promo. We have a Fed show where we will consider this.
I keep thinking about that Twitter viewer who wrote in that the only way he could have been more hawkish, Jay Powell.
He's coming with a hawk on his shoulder.
And if he had a hawkish tattoo, a hawk on his T-shirt, and just screamed into the camera.
That was probably tweet of the week, wasn't it?
Absolutely.
Well, I like what you said. He could just give the Jackson Hole speech again.
Just rip it out and regurgitate it.
Exactly. While preaching.
Futures positive, 0.4 to 1%. Tom can do the sound effects. He's good at that. Live from London. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Justice Department says Donald Trump is trying to have it both ways when it comes to classified documents seized from his Florida home. In a court filing, the government says the former president argues that the documents are personal property and also covered by executive privilege. The government wants to keep using about 100 documents, while a so-called special master reviews them for privilege issues. In Japan, the yen has rallied further away from the closely watched 145 per dollar level. According to Nikkei, the Bank of Japan conducted a so-called rate check in the currency market. It's a move considered a precursor for intervention. The yen has fallen more than 20% versus the dollar this year due to the widening interest rate differential between the two nations. Travelers in Hong Kong with COVID will no longer have to stay in isolation hotels or quarantine camps. Instead, they'll be allowed to remain in designated quarantine hotels. That marks another easing in the city's travel policy. The move comes as Hong Kong prepares for several high-profile events, including a summit for global bankers and an international rugby tournament. In Germany, the government is open to the historic step of fully nationalizing the country's biggest natural gas importer. The concern is that the energy system faces a collapse. Chancellor Olaf Scholz's administration is ready to inject more capital into Uniper and increase its stake to above 50%. Uniper lost $12 billion in the first half of the year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
From New York City.
Here in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
To recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
We've been bullish for 2 years now, and all we've seen is this sort of gyration, particularly led by uncertainties around demand. I think there is a degree of sort of confusion as to where demand will ultimately emerge or trend to over the medium term. We still believe that demand will ultimately continue to grow to 107, 100 million barrels by 2030.
Kristen Malik, the global head of energy strategy at JP Morgan Securities. So cool to catch up with him. just yesterday. Equity futures right now up 0.4% on the S&P 500. If you want to take a look at crude, positive by about 0.75% at 87.93. What did AMH's reporting point out yesterday, Lisa? They're going to come in potentially buy at $80 to refill the SPR?
Right, that once it falls slightly below $80, they will come in. And it raises questions at a time when you would wonder why they're putting the floor in for prices there. I mean, that's sort of the speculation. Or is this really an attempt to appease oil companies, saying, look, we do have your back. We're not just driving you out of business.
Can I ask you both, and Tom, perhaps you can speak to this, what you think about how politicized the SPR has become? How politicized
it's always been that way. I was just thinking of that, John,
even
before.
more so
You're like channeling
recently.
me today.
Well, we
me.
have that special kind of relationship, Tom. I'm thinking back to the pandemic when the Trump administration wanted to refill the SPR at much, much lower prices.
It's been,
and there was some real pushback from the Democrats at the time.
Political from day one, and there were some experiments with President Clinton where we tested actually what the microeconomics is, the price theory is of what's going on, but nothing like what we're going through right now. And I would suggest some of this has got some real uncertainty to it. We really don't know what's going to happen on the margin as we refill whatever we're refilling. I still don't know. Where is the strategic reserve? Is it?
It's at the lowest.
It's in Topeka, or?
Oh, you mean physically?
The actual geographic location. I'll get you some coordinates.
Topeka, or
Do you think that we would know that randomly?
The precise coordinates
exactly.
of where that.
Get on it, John.
I'll get on top of it, Tom.
Absolutely. On oil, Olga Karkova joins us now, Deputy Director, European Energy Security at Atlantic Council's Global Energy Center, the Atlantic Council, with some real commitment to talking about the effect of hydrocarbons on our lives. Olga, I want to get beyond the winter and the discussion, the headline discussion, if you will. How does Germany, as John has mentioned many times, change their policy to a better oil outcome? How do the Germans actually affect a policy change?
Thanks so much for having me. I mean, it all starts about completely reshifting the energy system of reliance on Russian energy sources, creating an energy system that is a lot more efficient, looking at alternative supplies and making those connections and those kinds of agreements. So it is an unprecedented shift. And it's also relooking at its industry, one of the biggest economic drivers in Germany, of course. That is why Germany is suffering so much at the moment, is because some of the industries are forced to curtail. So these are the things that the Germany would have to look at.
But Olga, what's so important here is you say that, and every American viewer and listener is deciding if they should get in an Uber today that's a Chevy Suburban. I mean, we look at Europe like it's already efficient. And part of that is nuclear energy led by the French. Do the French reaffirm an atomic commitment coming off of this crisis?
Yes and no. In France, nuclear energy has always had robust support, not so much in other countries such as Germany. Take a look at how long the conversation, starting in February when the brutal war attack started, that conversation about restarting nuclear power plants in Germany has gone on for over 6 months. And there's finally been a decision to extend them for several months, not even maximizing into how long they could be extended, 2-3 months, and that's it. And there's a lot of pushback against that. So yes, in some ways it has reinforced the value of nuclear, clean, reliable energy. At the same time, for some countries, they're still struggling with that. But to add another layer of complexity, we're also seeing climate change and warm waters making it more challenging to cool off nuclear power plants. So this is a barrier that's absolutely is possible to overcome in the future as we anticipate further climate change impacts and further higher temperatures. But this was something that was unexpected to be another layer of crisis this summer.
One of the biggest nodes of disagreement, or divergence, I should say, between the European Union and the United Kingdom, and to some degree the United States, has been how to incentivize energy companies to invest at a time when they want to reduce prices, when they want to reduce the income, essentially, to some of these companies. You're seeing Germany propose nationalizing, for example, some of their energy companies, and then you have the windfall tax, the European Union, the aversion to do so in the UK, and now potentially a floor under gas prices and oil prices in the United States. What's the right approach?
Right. So, yes, Ursula von der Leyen in her State of the Union address did mention addressing revenues and being able to take some of those back to the consumers. Now, that's a different conversation. I think a way to be able to encourage companies to invest is companies and industry, they want long-term contracts. So we talk about 15 years, at the least, 15 years at the least, 20 years ideally. Now, as these countries are looking into what their energy mix will be in 5, 10, 15, 20 years, and also meeting European climate strategy and Paris goals, I think there's a role for the EU government to be very clear about, look, these 20-year-old contracts will still be valuable. And if you're concerned about risk, or if you're not sure about what your energy mix will be like, we will come in and we will mitigate some of that risk for you. But that is the way to drive more investments in the sector, because sector wants long-term commitment, and then purchasers in countries, utilities, nationalized or not nationalized, they want that level of flexibility. But it's also interesting because we're seeing companies respond to that and provide flexibility in terms of attaching and saying, okay, at this point, we can guarantee that you will receive net zero LNG or reduced carbon intensity LNG. We're also looking into, in this many years, being able to blend in this much hydrogen. We're seeing these new creative tools. And of course, some companies are coming in and saying, can they shorten those contracts in any way? But for the most part, they really want those 20-year commitments to drive those investments.
Olga, thank you. Olga Kukova there of the Atlantic Council. And here's the answer, Tom. They are in the salt caverns at 4 major facilities.
Yeah.
2 in Texas, 2 in Louisiana.
I didn't know that. Amy from New Jersey listening.
Now we all know that. I don't
Bloomberg
remember
Radio.
the coordinates, okay?
Amy emails
but
in and
just
says,
double check.
Amy emails in and says oil's not in Topeka. I didn't know that. I'm learning every day.
I think we knew that much.
Yeah.
Well, they're going to try and refill it anyway, if crude gets down towards 80.
Exactly. And then there is this political question about the use of the Strategic Petroleum Reserve in a political manner, although you could argue that that's sort of what it's designed for, right? To mitigate crises. The question really is just when you get a crisis.
I'm going to go
crisis ahead of the midterms.
Well, I mean, you could make the argument that that's supported some of the retail spending that you've seen continue to go, which is possibly why we saw a faster than expected pace of CPI.
Okay.
You could make a lot of connections there.
Sure,
but I'm just saying, I mean,
I'm
look, I
open
think
to explanations. I always am.
Yeah, you'll inject them later.
Do
you think the audience detects a little tension here as we're deep into
love
our
each other, and
we 8
always
days
have done.
in London?
Been friends for a long time.
Hours.
Positive. 0.4%. Whaley of BlackRock is coming up very shortly. Looking forward to that after a major sell-off in the equity market, and I think we can call it that. Yeah. It's the biggest one-day move lower on the S&P 500 since summer 2020, and this is a small bounce.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock. It has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs. And the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
There are several pockets of this country that are still suffering from elevated inflation.
We know the Fed is going to slow it. The Fed has to slow it. We just have to debate how much above 4% they have to go to slow it.
It really is 2023 where you look for inflation to come off further.
If there's any doubt at all about 75, they're definitely going 75.
The Fed is probably going to overdo it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Did you notice that Lisa walked into breakfast this morning, Tom, with an extra skip, hop and a bounce? And a massive smile
Hold on.
off the back of yesterday's price action. Live from London this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures with a bounce up 0.4%. TK off the back of the biggest one-day fall on the S&P 500 going back to 2020.
Big move. I'm calling it Reset Wednesday because what I really saw there, John, with one exception I'll mention, is that it was just a jump condition reset to where we were before the soft landing disinflation dance. The one exception is the way we closed yesterday afternoon was not good.
At the lows, and now it's a hard landing conversation. And Lisa, credit to you. I'm only joking. You've talked about the reality of the situation, how hard it is for financial conditions to loosen in the face of what this Fed is trying to achieve.
No one is going to cheer a $1.5 trillion rout in the S&P 500. If anyone does, that is a rather unsavory thing. So I don't want to think that that is sort of my feeling here. There is a sense that there is a dissonance out there, a feeling of unreality that is starting to change. And I think that is what people are looking at.
We're going to see it in PPI today?
Well, does PPI matter, right? It'll matter if it confirms what we heard yesterday. Will it matter if it doesn't? And I really raise this seriously because
I'm with you.
I just think that right now, people are now on the hawkish bandwagon.
So let's set the stage. We're at 75 for next week, maybe something more. And it's really not even about that. It's about what happens afterwards. Because yesterday in that print introduced the risk that this Fed has to go even bigger for a whole lot longer. And I heard that from pretty much every single bank. They were all looking for the step down, 75 to 50 down to 25. And now there's the risk that doesn't develop.
This is the conundrum, right? If you allow consumers to keep spending, if they get a reprieve from gasoline prices, then they have a better time of it. Then does that actually lead to a more aggressive Fed that has to curtail the economy that much more dramatically and harshly?
How much damage are they willing to do, Tom? Unemployment into year end. Next week's interesting, not just because we get a rate hike and a news conference with Chairman Powell. Tom, it's interesting because we also get the projections in the summary of economic projections. So you get the forecasts. And we've had a lot of pushback against some of those forecasts.
I do agree that the forecasts this time around matter after what we saw yesterday. I would suggest with their dual mandate, I believe, John, you mentioned this yesterday in the Blur, they have a dual mandate, and the idea that they're going to slam America into recession really pushes against that mandate. I'm in a camp where they may be assertive, but they're going to be assertive over time.
Will that dual mandate be in conflict pretty soon, Tom?
Can we clear something up here quickly? I think it's very important, folks, as John mentions, that we all saw each other at breakfast today. The breakfasts we have are completely different. I'm doing the Churchill full English thing. You're eating some damn oatmeal fruitsy pie granola thing.
Sure.
And Lisa's breakfast, folks, is to go run 5 miles.
And then Bram have room service.
Lisa just so everybody knows.
Lisa won't sit with us.
I would sit with you. I get started a little bit earlier, that's all.
At 6:30 in the morning.
Yeah.
Cool. I've got no problem with that whatsoever. Okay. Futures are positive. Tom has this massive breakfast. Anyway, on the S&P, up 0.4%. Yes. Yields are higher as well, up by 3 basis points on a 10-year, 343.91. We talked a lot about the short end, the front end of the curve, through 370, Lisa, and approaching 380 at one point in the last day or so.
Yeah, and Tom, you raised a point earlier where you were talking about how it's not just the Fed's response to these numbers in the U.S., it's globally what the response is.
I strongly feel that.
And we're hearing from the ECB chief economist today, who comes out and says that inflation is still way too high and that policy is still way too accommodative. So that's what we're hearing, the latest out of the rest of the world. At 8:30 a.m. we get U.S. August PPI. Does it matter? It will matter if it comes in hotter than expected and confirms what we saw yesterday. Perhaps on the margins, if it comes in much weaker, it will confirm things for people who are coming out and saying, you guys all have it wrong. Either way, we are coming off such a high level. The bar is pretty high to really move the needle. At 10:30 a.m., EIA crude oil inventory report. This comes after that reporting that Anne Marie helped put out there yesterday about what happens if oil prices get down too low, or to $80 a barrel, too low, I guess I'm saying in quotes, for this administration. They will come in, they will buy. How much do we actually see demand destruction starting to abate and people going in and actually using more gasoline now that prices have gotten lower? And today, this to me is a big deal. It's a huge departure from the COVID-era policies, with Chinese President Xi Jinping beginning his first trip out of the country since the pandemic. He is going to be in Central Asia. He is going to be meeting with Russian President Vladimir Putin. How much does this signal a shift that goes beyond just his personal travel schedule, John?
A dictators' convention that we'll all be watching closely.
You go with words.
Yeah, Wei Li, the global chief investment strategist at BlackRock, joins us now. Wei Li, I want to go straight to a quote of yours on a recession in Europe. You've been on top of that story for a while. You've pushed the same story recently, and you've asked the question, why aren't equities pricing it? And you're not alone, Wei Li. Why do you think that's the case?
Why do I think equities are pricing in not a recession? I think there is a lot of hope in markets that the innovation of corporates would eventually continue to come through, and margin would stay elevated. But in our view, actually, that is unrealistic to expect that in this environment where cost of production is going higher, labor shortage is prevalent, not just in Europe, in the US as well, where I am right now. It feels like I'm manning your studio for you today. So in that kind of environment, we expect margin to actually come under pressure, and eventually the current market consensus for earnings growth, not just in Europe, but also in the US, will have to come down to meet the reality that we are heading into a recession in Europe this year, and one in the US likely next year as well.
Wei Li, I find your note to be the grimmest note on Europe I have read. I will not mince words about it. It's very, very difficult. Does Madame Lagarde have the nominal GDP firepower, the economic animal spirit to affect the rate path you suggest? Do they have the interior structure to do higher interest rates?
I want to pick up on something that Lisa talked about, which is this idea of unreality, right? So we're in an environment shaped by supply constraint, which is very, very different from the great moderation that has been shaped by demand and spending. And in this environment, actually, the trade-off facing central banks are so much harder, the trade-off between growth and inflation. And so far what we have heard from Madame Lagarde is perhaps some lip service to this trade-off, but not really acknowledging how costly it would be to actually bring down inflation through hiking rates and what that means for growth and what that means for the labor market. So we believe that until central bankers acknowledge that trade-off and choose to live with inflation, we are going to be in this environment for an extended period of time where the politics of inflation will be prevalent instead of the economics of inflation, which will become clearer as we enter next year. But right now, all eyes on fighting inflation, which, based on what we saw yesterday, the core part of inflation is proving to be sticky and persistent.
Wei, a lot of people would agree with you about Europe, and you're hearing a lot of notes, or reading them, that are saying underweight Europe. It's not so clear in the U.S. It's not consistent in terms of the messaging. How far away from realistic pricing do you think we are in equities, even after what we saw yesterday?
Right now, obviously, markets are moving very, very quickly. Yesterday, very dramatic sell-off, but today bouncing back a little bit. We believe that actually more needs to be given back to properly reflect the fact that we should be looking at a earnings recession. So right now, if you look at year-to-date market pricing, we think that actually the rate path is to some extent fully reflected in equity pricing, but the fact that earnings is going to stall greatly is not yet reflected. In comparison, however, credit is pricing in a version of growth stalling, which is why in a whole portfolio context, we prefer to own credit over equity. And just building on this idea of unreality. Now, Lisa, you asked about the U.S. We also believe that the Fed has yet to acknowledge the very difficult trade-off between growth and inflation. We'll pay attention to the economic forecast next week. But in our assessment, actually, in order to bring inflation back down to 2% over 2 years, we could be looking at 3 million additional people out of a job, and also deep recession, 2% contraction, which is currently not being talked about. This is the sort of tough trade-off that we're looking at in this environment shaped by supply constraint, and we think that markets will wake up to that in time.
Wei Li of BlackRock. Wei, fantastic, as always. Was that the big reality check yesterday, Lisa, to get us to think about those things just a little bit more deeply?
Well, it was a reality check when it comes to the rate path. I think what Wei is talking about is kind of echoing what we've heard from Mike Wilson over at Morgan Stanley. It's the earnings recession story and how deep that will go and which sectors will experience that the most directly. And you did see that with the semiconductors, for example, yesterday, disproportionately selling off because that just sort of exacerbates the trend that you'd already seen being priced in and communicating with some of the earnings.
This conversation about a soft landing, Lisa, and maybe a short and shallow recession, does short and shallow get it done to achieve what this Fed ultimately wants to achieve? Isn't that what Wei's really speaking to right now? The Bank of England is the only real major central bank right now that's actually forecasting a recession.
Do they want to really be that person? I mean, I'm sitting here, I guess that,
do you get to choose when you make the forecast?
Okay.
I want to come across as a nice guy, or do you make the forecast?
Enough. A lot of people are saying that there is a soft landing scenario, but it looks like it's pretty unlikely.
Sam Stovall is going to join us from CFRA, Tom. Looking forward to that one. On this equity market bounce of 0.4%.
Well, it's important to have Sam Stovall join us here to talk about what's actually going to happen, the dynamic of revenue and critically of earnings.
Looking forward to the conversation. Yields higher by 3 basis points on your 10-year, 3.44. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China is facing its biggest drop in oil demand in more than 3 decades. According to the International Energy Agency, Chinese demand will decline by 2.7% this year. Now, much of that is blamed on restrictions imposed as part of China's COVID-0 policy. Ukrainian troops are keeping up the pressure on retreating Russian forces. Ukraine's border guard services said the army has now retaken a town just 2 miles from Russia that was seized on the first day of the war. Russian troops have been seen withdrawing toward Moscow-controlled Crimea. Google has lost most of the first round in its fight to overturn the EU's record $4.3 billion antitrust fine. Judges upheld the vast majority of the European Commission's arguments, but they cut the fine to $4.1 billion. Google is accused of imposing unlawful restrictions on manufacturers of Android mobile devices and mobile network operators. A strike set for Friday could prevent American railroads from transporting farm products and other key goods. It could cost the U.S. economy $2 billion a day. President Biden is personally trying to break the logjam between railroads and labor unions. Labor Secretary Marty Walsh will meet with railroad and union representatives today. And Queen Elizabeth II's coffin is now at Buckingham Palace. Today, there will be a procession through London to Westminster Hall, where she will lie in state for 4 days before her funeral. Members of the public will be able to pay their respects 24 hours a day. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we're seeing more and more people say, I have to worry about me as a person, I have to worry about my family, I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
from New York City.
Here in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
have a great evening.
To recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
When U.S. inflation numbers are released,
A stunning inflation report.
Bloomberg brings you crucial data at terminal speed.
Core rises 0.6%. That is double last month.
And instant expert analysis.
There goes Goldilocks.
Republicans are really going to harp on that. This is about a narrative shift in markets.
There clearly isn't going to be a pivot anytime soon.
Sooner or later, they're going to make a policy mistake.
Ouch for America, but double ouch the rest of the world.
Nobody covers the economy like Bloomberg, your global business authority.
The stock market doesn't necessarily reflect the state of the economy, as you well know. And the economy's still strong, unemployment's low, jobs are up, manufacturing's good. So I think we're going to be fine.
We're going to be fine was the message from every single equity market bull to clients yesterday after the inflation report. That was the president of the United States. Equity futures right now positive 1/3% on the S&P 500. Yields higher by 3 basis points on a 10-year, 343.91. We're bouncing back on equities. Yields just keep pushing up. In the FX market, euro dollar just about holding on to parity, 1.0000. Tom, that currency pair positive 1/3%.
And I mentioned it, John, the real yield, I did the math, I think it's 221 basis points from the bottom a number of months ago up to 100 basis points positive now.
Wow.
And that changes the decision tree for everyone out there.
And then you've got to layer QT on top of all of this. Tom.
Yes, I
Does
agree
it
with
take
that.
you back to late 2018 and when markets really started to fall apart, particularly in credit, and this Fed had to back
Don't
away?
look at me, look at Bramall on that question.
No, it's different because inflation is a completely different story.
So
Now
they
that is
can't
the
back
mandate.
away.
They can't back away. So it's actually
There we
different than 2018.
It makes you
that
wonder
way.
why credit spreads aren't where they were.
Exactly. And Wei Li was saying that they have priced in more of a slowdown than equities, which raises a whole host of questions, that, in my mind anyway, because they really haven't done that much.
Here's a paragraph as we go to Michael McKee and Anne-Marie Horton as well. The 2022 railway strikes are an ongoing industrial dispute that has seen the largest instance of industrial action in the country since 1989. That would be of the United Kingdom. So true suddenly in America. Michael McKee, let me begin with you. I thought we were strike-free in America for the most part over 30, 40 years, and yet we must consider railway strikes.
Oh, we must consider them. This is a hand grenade rolled into that rosy scenario that Joe Biden was talking about yesterday, ironically, because he's the most labor-friendly president in years. But 100,000 railway workers for freight railroads, including Union Pacific, CSX, BNSF, which is Warren Buffett's railroad, Norfolk Southern, they could walk off the job starting tomorrow. And it's almost impossible to overstate the damage that would do to the U.S. economy. Most of the U.S. economy's farm products move by rail, and it's almost harvest season. And remember, yesterday, food prices went way up in the CPI. Already, one railroad, Norfolk Southern, is not accepting cars, new cars for shipment across the country as of today. They don't want cars stranded out there. And we've been short new cars, and prices have been rising. And so there is an inflation problem. There is a recession problem. This could really, really screw things up.
Anne-Marie, talk to me about the politics of this and how you expect Secretary Walsh to engage in what Mike McKee's talking about.
Well, he's going to have a big meeting this morning with both the rail carriers and the union representatives to try to get an agreement. And while Washington does seem somewhat calm, David Weston was talking about this with me yesterday. There's always these 11th hour deals, right? You wait to the last possible moment to strike a deal. The White House, at the same time, is drawing up contingency plans and looking at what emergency powers the president would have to enact to make sure that what Mike is saying, these flows of goods, could continue. One of the problems they already have, though, is that already you see certain goods, they're starting to stop. Things like ammonia, which is desperately needed for fertilizer, which also, of course, is needed to grow crops and to feed our table. Huge inflation story. It is also used in hazardous explosive products. You can't leave that idly by in a train car. So already you are seeing these companies stop some of these goods. So the impact already is there. And what they want to do is really try to warn this off. They They need an agreement by Friday because politically, this is not a good look for this president less than 2 months away from the midterm elections, especially as he said he wants to be the most pro-union president ever.
Well, that's exactly where I wanted to go to build on what John was talking about, which is this is the delicacy, Anne-Marie, of the dance for this White House. And for Secretary Walsh, who has been a big labor proponent, does this pit them against the labor union? Are they going to talk about some sort of financing to try to get this through? What's the solution?
Well, it's very awkward because they want to be seen as pro-labor, but at the same time, they also need an agreement. And they need it very quickly. They need it by Friday or really today, because if you want to make sure those goods are starting to flow and they're not stopping them from loading, it's a tricky one. And you're going to see them delicately, politically in the press come down the line in the middle, but they're obviously going to be putting pressure on both sides here.
Mike, let's cut to the chase of what matters, certainly to the fools like me on the East Coast. This is about freight. It's about moving America's stuff. Does this affect the Acela? Does this affect the Northeast Corridor and passenger trains, for that matter, nationwide?
Got bad news for you, Tom. It does. Right now, Amtrak has already suspended some long-distance train service because they use freight railroads' tracks. And we've also heard from commuter rails in Northern Virginia, California. They are going to shut down if the railroads shut down. So that'll affect further the commerce in a whole lot of cities in America. So this is a pretty big deal for everybody.
Guys, thanks so much. Michael McKee, Anne-Marie Horton, thank you so much for that brief in America. I want to get a brief right now in London with John Farrell. John, let me cut to the chase. Why do the trains in Switzerland, Germany, France, why do the trains in your United Kingdom run so much better than the disgrace that is America?
I wish I had a 60-second answer to that, Tom, so we could correct everything. These short
we can get a beverage and work on this.
I don't know, but I think we've both experienced the seamless transition from one train to another in Switzerland. I was actually just reading a story here in the Metro in London about London Heathrow today. They are cancelling some flights out of respect for the Queen to ensure silence over central London.
Oh, okay, wow. They come in.
What do you make of that?
It shows you just how big of an impact
how big a deal
really
this is.
Yeah, exactly.
Yeah.
Incredible story to start reading, sure.
Let's paint the picture of this. John, help me out here because I'm back in economy while you're up front looking out the window.
Nobody
you're coming in and you overshoot London, come around just this side of Rotterdam, circle.
You circle, and maybe circle a
and
little
then
bit
you
more.
turn around and you get a rock star view of London.
You hope.
Literally, am I right? Literally flying over Buckingham Palace.
That kind of direction, Tom, depends how many times you.
I've never seen the view myself.
Because you know when you're coming down at 6 a.m. and then everyone's coming down at 6 a.m. and you have to keep going round and round.
Yeah, I've done that. I've enjoyed that.
London Heathrow. Anyway, that's a separate complaint.
What's your tour guide
Perhaps getting a little bit too personal. At 9:20 Eastern Time, Lisa can't stop laughing. 9:20 Eastern Time. That very emotional procession is going to begin. That journey from Buckingham Palace, the gates will open, and then the coffin of the Queen will be followed by the royal family, the senior royals, all the way through the Mall, up through Horse Guards Parade, through Whitehall, and then on to Westminster Hall. And we'll be following some of that for you just before the opening bell. Going into that opening bell, equity futures just about positive, but let me tell you, those gains are fading. Those gains are fading. Live from London, this is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
The bounce fades this morning. Good morning to you. Futures just about positive by 0.2% on the S&P 500. Equities up by 7 points. Yields higher again by 4 basis points on a 10-year, 344.68. We were just above parity on euro dollar. We give that up too. Euro dollar still positive by about 0.25%, but things starting to develop in the last, I'd say, 30 minutes or so into the same direction we travelled just yesterday, just without the might and velocity. That was a brutal move. That's the first time I've said brutal so far this morning, Bramo.
That's the joke, because you've said it pretty much.
This hour, at least, for the last 30 minutes.
I just want to point out that if you take a look at two-year yields, they're basically at 3.8%. So they've just surged right back up to the highest levels that we've seen since 2007.
That's the poison in this market right now. It's the move at the front end. It's the move, as Tom said. Tom, you've said it a million times over the last day. The move in real yields is just so big.
Yeah, let's go through that very quickly here before our qualified guest. You take the nominal yield, the one we quote all the time, and you take out whatever inflation component you're using, and you end up with the inflation-adjusted yield, John, which is the real yield.
And that's what this Fed is trying to achieve. Get real yields up, get financial conditions tighter, get inflation back down.
Clinic now in a brief for Global Wall Street. Edward El Husseini joins us right now. He's been a huge value for us with senior interest rate strategist at Columbia Threadneedle. Thrilled he could darken the door today. Ed, I want to cut to the chase and look at what the pros look at, which is a spread market, but I want to get away from the vanilla 210 spread, the difference in yield between the 10-year and the 2-year. Which is a spread that gives you most information, giving the turmoil, the brutal moment we're in?
Yeah, I mean, to your point, perhaps one of the most important spreads right now is the steepness in the euro-dollar curve in the front end. So in other words, expectations for what the Fed will do between now and, let's say, the middle of next year. And what's been happening is we're front-loading hikes. We're raising the terminal rate, in other words, the high watermark to which the Fed will get to. And we're pricing the Fed to stay there for longer. All of those are tightening financial conditions.
Right. Zero Hedge had a Bloomberg chart, and I think it was last night, where they had a terminal rate, that rate out there somewhere, of, I believe, 4.33%. Let's not guess what that rate's going to be, but at what level does it become harmful in terms of price down, yield up?
What level does it become harmful? It's tough. I mean, the current level of yields that are priced for the front end, to your point about, let's say, 4.25% to 4.5% by the second quarter of next year, they are starting to damage the economy, no doubt, right? You can see that in the housing market most prominently. But there is a lot of damage that's in the pipeline right now that we will see hit the economy with a lag. So to the extent that that starts to materialize, we will see the front end start to stabilize over time as that long end gets to about 4.5%.
Ed, we've been talking about what we're pricing in right now. We definitely are pricing in a more hawkish Fed as we've seen the two-year yield climb to the highest levels since late 2007. But within credit, are we seeing corporate debt price in the revenue slowdown, the profit slowdown that Whaley of BlackRock was talking about, that Mike Wilson at Morgan Stanley is talking about, and that perhaps the sell-off yesterday really represented?
Yeah, I would say there's sort of two things happening in credit. One, the underlying corporate balance sheet strength, particularly in investment-grade credit, remains very solid, despite the marginal slowdown in the economy. In the high-yield space, we're starting to see, obviously on the margin, low-quality companies experiencing refinancing issues. But by and large, credit markets have behaved in a very orderly way. So to the extent that we are tightening financial conditions, credit spreads are wider across both investment-grade and high yield. It's happened in a much more orderly way than the moves we've seen, for example, in equities.
So are you seeing opportunities within the rates space? I mean, are you seeing yields get to a place where we've seen the highs, for example, or getting close to the highs in the 10-year yield? I mean, I know that that's a dangerous thing to say because every time someone says it, then it tests it the next day. But I'm wondering if we're getting to that place where you're starting to see value again in duration.
Yeah, I mean, duration's been very interesting. I think we've been early in terms of seeing value in duration. The 10-year yield has moved, plus minus 100 basis points every, 6 to 8 weeks. So there's not been a lot of stability. Interest rate volatility has been exceptionally high. But if you take a step back, what's happening here is the Fed's putting a lot of credibility in play in the front end of that curve. If we look at inflation expectations further out, they are at year-to-date lows, to Tom's point on 10-year break-evens. And as this process plays out, as inflation starts to cool, and as the economy starts to slow progressively into the middle of next year, 10-year yields at 3.5% to 4% will look exceptionally attractive.
Ed, I want to go retail on you right now. Forget about spreads, forget about Delta and all the rest of it, the hedging and such. Retail out there on radio and TV now with Bloomberg surveillance is going, wait a minute, price down, yield up, month after month. What happens if we break through to new lows on price looking at different Bloomberg total return aggregate indices? Is there like panic like equities? We've never been here. What happens when we break down to new price lows in fixed income?
Yeah, I mean, there's been significant outflows in the retail space out of fixed income, given the drawdown. To your point, the drawdown has been exceptional this year. Two pieces of good news on the horizon, right? In terms of yields increasing, we started out with 10-year yields at 50 basis points a year and a half ago. To the extent that yields rising from 50 basis point to 1% do a lot more damage than yields rising from, let's say, 3.5% to 4%. So the pace at which the drawdown's happening is decelerating. And then if you take a step back, the income component, whether it's from high-quality credit or treasuries, now is a lot more attractive. Right. So you have a lot more cushion as a retail investor coming into the fixed income market right now.
Lisa, 78, I believe, 79. You got a monthly statement, loss. Next one, loss. Third monthly statement, loss. That was child's play compared to where we are right now for people that own bills, notes, and bonds.
Yeah, a bear market in bonds is not something that people hear about very often when you talk about 10, 20% of a drawdown. Let's go global here and take a zoom out. There had been, before this past year, this search for yield, and the U.S. was the haven spot, and a lot of that money was coming from Japan. We heard overnight about the possibility of abandoning or not abandoning. We didn't hear any specifics whatsoever, but there are policy steps that potentially we could hear to edify the yen, to support the yen with concern of what's going on. How closely are you watching that situation with the systemic import of that currency and, frankly, the entire Japanese GDP market?
Yeah, no, it's very important, both in terms of what's happening in the European rates market and the Japanese rate market. Increases in rates there could spill back into U.S. rates, particularly the long end of the Treasury curve, no doubt. At the same time, in the grand scheme of things, the Fed strategy and the domestic inflation story here dominates by far. And so if you're a cross-market investor and you're looking at U.S. rates, European rates, and Japanese rates, U.S. rates, in my mind, continue to offer the best value on a risk-adjusted basis right now.
Ed, very quickly, you're not doing the Fed dance, but let's do it right now. What do you expect next week?
No doubt the Fed signaling that there is more work to be done. So to the extent that they had a terminal rate of, I think the median terminal rate was 3 3/4, that probably moves higher, let's say 4 1/4 to 4.5% by the end of 23. And very likely they start to incorporate a slower economy, so higher unemployment into their forecast.
Ed, thank you. All the guests going into New York, into the studio.
I know.
Just when we're not there. Have you noticed that?
You think it's a coincidence?
I've got no idea.
We hear they're not around.
Tom's not there. Let's go.
You'd be on your phone anyway, ignoring everyone.
That's
Ed
true.
Al-Husseini of Columbia Threadneedle. Ed, thank you, sir. As always, you're trying to be very diplomatic around the BOJ story.
You didn't agree with it.
No.
You just pushed me around.
The stage is yours to tell us what you really think.
They say they're trying to jawbone the yen to a stronger place. They're saying they will intervene if things get out of hand. They aren't going to warn. They aren't going to give details, but they're going to do it. What are they going to do? Abandon the peg?
Are they out of hand right now?
I mean, I just am wondering, do they have any sense? Right, exactly. At what point, what's the threshold for them getting involved? Are they just trying to throw this out there to scare people away from shorting yen too aggressively?
They keep saying like almost there's some kind of disorderly dislocation in the FX market.
It has been for a while.
Yet it's so highly intuitive, we can all explain it. Everyone else is hiking by a lot, and the Bank of Japan is not. And they're also doing something in addition to that. They're capping 10-year yields. I believe the upper band is 25 basis points on a 10-year.
So
no one else is doing that.
Right. So are they going to abandon that? And if that's the case, what happens to the Japanese bond market? How quickly does it reprice? Who is going to be there in their pricing, considering how stagnant it's been, that it has not been a market for as long as it has?
Do you know what I'm taking abuse for? Heathrow. People writing in to tell me Heathrow is the worst airport.
Oh, I disagree. The taxes are the worst.
And you're responsible
what
for
you pay in fees?
Why I would take that
Oh,
personally?
I
Do you know what I said
disagree.
back?
Oh, I love
I
it.
think they've misspelled JFK.
I love it. I love it.
On departures, JFK.
It's a shocker. Well, now we can beat up on them because LaGuardia looks nice.
Hey, LaGuardia looks good.
It looks really good.
I agree. LaGuardia looks better.
Yeah, okay, I'll go there. But I'm sorry, it's like the trains in Europe. They just somehow do it better. Can I just stay within the wonderful time we're having here amid the funeral and the somberness of the Queen's moment? John, the Vindaloo that you and I had last night, that fiery red, it was... I had never tasted anything like that.
Where did you go for Indian?
Down by the river.
Okay.
You know.
Was it good?
I couldn't taste it. It was so damn spicy.
It was so hot?
Yeah, I don't do that. And
okay. Would you like me to recommend somewhere for you?
Yeah, you could. You know, you're going to do some hedge fund alley thing.
Something high end for you would be something like Jamavar in Mayfair. I think that might be your kind of thing.
It's fine.
Lisa and I'll go somewhere else.
But we're trying the different Vindaloos.
Okay. Michelle Meyer's going to join us very shortly from MasterCard. Just things to say.
Important
about this
conversation, seriously.
Important things.
Yeah.
On the housing market as well.
Yeah. Yes.
Given where rates have gone to, just wow. Equities positive 0.2%, live from London. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. European Commission President Ursula von der Leyen laid out plans to raise $140 billion to rein in the biggest energy crisis in decades. The funds would come from capping revenue from low-cost power producers. Von der Leyen's proposal is just the start of what's likely to be fractions of discussions among EU nations. In Germany, the government is open to the historic step of fully nationalizing the country's biggest natural gas importer. Chancellor Olaf Scholz's administration is ready to inject more capital into Uniper and increase its stake to above 50%. Uniper lost $12 billion in the first half of the year. The Biden administration is considering whether to replenish the Strategic Petroleum Reserve when oil goes below $80 a barrel. Just 2 years ago, Democrats blocked former President Trump from filling the reserve at a fraction of that price. Senate Democratic leader Chuck Schumer called the Trump proposal a bailout for big oil that cost the U.S. billions in potential profits. U.S. job growth is expected to slow this decade as the labor force ages. That's according to the latest projections from the Bureau of Labor Statistics. The report shows the 0.5% projected annual growth rate is half the pace recorded in the decade through 2021. About 9% of workers, they're expected to be at least 65 years old, roughly triple the share 3 decades earlier. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
We will never break. We will never break. Build on a foundation strong enough to stay. We will never.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of a solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
bring inflation back down to 2% over 2 years. We could be looking at 3 million additional people out of a job, and also deep recession, 2% contraction, which is currently not being talked about. This is the sort of tough trade-off that we're looking at in this environment shaped by supply constraint.
I don't think I've ever heard Wei Li that bearish. That was Wei Li, the global chief investment strategist at BlackRock, about 50 minutes ago. Equity futures this morning fading. Not much of a bounce now, up a little more than 1/10% on the S&P 500 after a move lower yesterday, the biggest one-day move lower, going all the way back to June 2020 on the S&P. Yields are higher by 4 or 5 basis points on a 10-year to 345.27. Talked a lot about a 2-year. 370. Did we breach 380, Lisa?
We breached 380. We're
there we go.
Almost to 381 at this point.
I cannot keep up. Cannot keep up, and that's why we're seeing this equity market, Tom, roll over.
And we're going to watch FX as a litmus paper of the system here, and to see sterling go down to a 114.57 to breach that. Weaker sterling would be something we're not there yet. Every day, every year, every week, surveillance is buried with hundreds, truly hundreds of books. And then there's one that trots across, Blas Farchi, and you go, yeah. And it's on oil, except Javier Blas made an incredible splash with his book, his effort here on the trading of oil worldwide. We're honored that we could join him in his London this morning. The theme of this trip on hydrocarbons is no one's willing to pay the cost, the social cost of where Europe is, where America is, for that matter, where Asia is. When do we start paying the cost of Mr. Putin's war?
Well, we are beginning to start paying now. Businesses in Europe have been paying it for several months already because they don't have price caps as households have in many European countries. So businesses, particularly small and medium enterprises, have been fully exposed to very high electricity and gas prices. And that's what we are seeing. A lot of companies actually reducing production or shutting down in countries like Germany. And now governments are going to have to start paying those costs because they're going to have to bail out not just families, they're going to have to bail out entire economies because at current electricity prices, nothing really works in countries like Germany.
You've seen the plans come from respective countries and the European Commission as well. Do you think they've confronted reality just yet, Javier, based on what you've heard?
They're beginning to confront reality, but there is this sense in Europe that they are doing a lot and that the worst is behind. And I keep saying to myself, we are only started to doing enough to keep things rolling. And I don't know if the worst is over. I have absolutely no insight whatsoever on what's in Putin's brain. But I know one thing, and you could see it behind us. It's kind of sunshine today in London, and it's a very pleasant day of September. We are not in winter yet. We have very difficult months ahead. I really will say the worst is over when we turn at mid-January. But to say the worst is over in mid-September, no way.
Well, I think we all wanted to ask a question about that. Is the worst of it just about the severity of this winter, or about the prospect, the duration of this story could be longer than just a single year?
I think it's a combination of both, but one thing that is very important is the duration. A lot of people in the industry, when I talk to CEOs in Europe, a lot of people plan for a few weeks, perhaps a couple of months of high prices. We are on month number 7, and probably we have another 6 in front of us through the winter of very high prices. And the potential that you are mentioning, even if prices come down a bit, someone reminded me, I tweeted a year ago, yesterday precisely, that German electricity prices for the 1 year ahead have surpassed the 100 euros per megawatt hour.
Where are they now?
And that was like amazing news. That was an all-time high, and no one could really think 100 euros. We're at 500 now.
Wow.
Even if we come down, we are not going to go back to what one day was normal. And also very important, that 100 euros was already double what it was normal before that. We are 10 times normal.
There's a question about how to support the build-out, the quick build-out of the resources, and this speaks to John's question about the length of the crisis, whether it's going to be a next winter or the winter after. We see in the United Kingdom an aversion to the windfall tax, an aversion to taking money from the big oil companies for fear of, and the big gas companies for fear of cannibalizing from their investment. The European Union is taking a different approach. Which is right?
Well, my politics will say that probably the European Union is more right than the UK. But at the end of the day, everyone is going to tax somehow to pay for this. It's a question of who you tax, the companies or the families and the whole economy. But the UK is going to spend 5% of the GDP over the next few months supporting the economy through the crisis. That's going to be borrowing money, and that's going to have to be paid through taxes in the future. It's a question of whether you tax everyone or you tax particularly some of the companies that they're benefiting from the high prices.
So if you try to crimp demand, if you go at it from that side, which I know a number of countries have started to do, how much activity has to get taken offline? How much production of factories has to be put aside and delayed?
The European Union has put some numbers. We need to reduce consumption of electricity in particular by 10, perhaps 15% at peak time. So we need to reduce activity by probably 10, 15%. And that at times, that some people will not sound like a lot, but that's reducing the GDP activity hugely. I don't know if that is even possible. And Europe is going to do, or the European Union is going to do and the UK, they're going to do a very interesting experiment. They're going to have to do that reduction in demand without the market signaling for that reduction in demand. It's going to be governments who are going to have to mandate a reduction. And we are going to see every company, every lobby telling the government, my sector is more important than everyone else. Sure. So spare mine and reduce the demand from that other one. I don't know how they're going to do it.
Javier, just quickly, what do you make of Germany's approach to this crisis, with Germany at the epicenter of it, compared to Germany's approach to the last crisis in Europe in, say, 2010, 11, 12? With Germany on the outside, looking towards the periphery?
I'm just going to have to, for one moment, forget that I come from one of the southern countries. I'm going to try my best. But putting aside that, I think that Germany has been very slow. The European Union have been very slow in recognizing the magnitude of the problem. People were warning them a year ago, 6 months ago, 2 months ago what's coming. How is it possible that only today strong measures have been announced, and these measures are not going to be approved for another 2 or 3 weeks? That, to me, is mesmerizing.
This is out of character, because you're not diplomatic in your column at all. It's been very diplomatic about this situation now.
Yeah, the columns have been really forceful. Very quickly here. Your book is about trading. Trading is about every once in a while there's tail risk and loss. I think there's an immense quiet about the commodity risk to Wall Street firms worldwide and the independent firms you look at on their trading risks right now. Are they exposed through leverage?
They are exposed to leverage. They are exposed because the market is moving a lot. But so far, what we are seeing is that they are doing fantastically well. Some companies have made in 6 months what they usually made in a year. This is a fantastic situation for the independent commodity traders. They are making.
What about major Wall Street firms?
Wall Street firms also, they are taking risk. But so far they have been on the right side of the risk, and they are making a lot of money.
Javier Blas, it's good to see you, buddy. Been too long. Javier Blas of Bloomberg Opinion. Coming up, Sam Stovall, Chief Investment Strategist at CFRA, on an equity market rally, a bounce that fades pretty quickly. I can tell you we're negative now. We're down a tenth of 1% on S&P 500 futures. From London, this is Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And frankly, when people leave 23andMe, I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. I want to build out a true consumer-empowered healthcare world, one that is outside of the existing system. And there's no greater force than government.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? Look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
The main feature of the US economy right now is that it's doing better than anybody thought it would be doing now.
We all hope for a soft landing. Certainly, I would hope that's what the economy can achieve. There's a possibility of achieving that. You're going to hear Fed officials that emphasize that possibility.
The Fed wants to see not just one print lower, they want to see 2, 3, maybe 4 prints lower.
We do see risks that the Fed overdoes it. We do see risks that there's a recession next year.
75 obviously is on the table, I think, in November.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
There goes the bounce, live from London for our audience worldwide. Good afternoon, good afternoon. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equities down and down hard in yesterday's session. We were looking for a bounce this Wednesday morning. Tom, that bounce fades pretty quickly.
Yeah, it faded, John, and it's the way it's faded. As Lisa mentioned in the break, it is correlated, but I would note sticking out like a sore thumb is a 10-year real yield out to a new high level, 1.01. Positive yield. That is a change for everybody listening and watching on Bloomberg.
Well, let's take it from 10s and bring it into 2s. Lisa, we thought the headline was going through 370, and then we just made another one.
Yeah, I'm just watching this because honestly, this has been the direction of stocks, just in the opposite direction. If you take a look at 2-year yields, they have climbed now solidly through 3.8%. and keep climbing. The pace of move has been jaw-dropping. The pace of resetting the understanding of what the Fed is going to do has shifted quite significantly.
That CPI print 24 hours or so ago has just disrupted the whole narrative around this step down from 75 basis point hikes to 50 to 25. Every single note I read from everybody raised the same question. Andrew Hollenhorst, the Citi's been on top of this more than most. He's looking for 75 next week and the potential for another 75 in November from the Fed. It raises a lot of questions about how much more work they have to do, and more importantly, for risk assets, how much more damage that needs to be done to the economy to get inflation lower.
We make fun of this whole good news is bad news kind of conundrum. But really what this means is the more momentum there is in people spending, the more ability to withstand higher prices and to sustain them even higher. It causes the Fed to have to really slam on the brakes that much more dramatically, and that's the problem.
John, I want to push against the gloom. An announcement moments ago about what you're going to see from well-run corporations. Comcast, I believe they're in the television business as well, with a share buyback authorization of $20 billion. And John, this is the economic challenge, the grimness, as you mentioned, the brutal moment we're in, and corporations looking at persistent revenue, persistent cash flow. Where do we invest? We're not sure. Let's buy back our shares.
How much business will actually get done? You've seen the guidance we're getting from the banks going into quarterly earnings season. They're basically telling you investment banking revenue not great at all. Deal making isn't happening in a big way.
Yeah, what JP Morgan said, it was down 50%. Deal making revenues at a time when you're not seeing.
Does that mean we're not going to do the SPAC report anymore?
I think the SPAC report's been iced for a while, but partly to that. To your point, Tom, you are seeing companies buy back their shares. There isn't necessarily the level of gloom in corporate America that matches the gloom elsewhere. But do they have to get gloomier for the Fed to achieve their mandate? I think that's the question.
Can I just say how proud I am of the team that we never did the SPAC stuff?
We just, point taken, yes.
Whenever you see a celebrity on TV promoting some kind of financial instrument,
run.
Just kind of run. You know, we get the same pitches from the same firms. We make a big effort not to make it happen. Just going to throw that out there and then quickly switch to the price section. Equity futures on the S&P down about a tenth of 1%.
I don't think you're going to be able to get through JFK.
We've all got issues. I've got things to say. Okay, yields up by 5 basis points. It's Englewood. They won't let me over the bridge now, Tom. That's it. 346 on a 10-year. On a 10-year in America. It's the 2-year we're so focused on, Lisa, from 360 to 370 and now out through 380.
So where are we headed, right? I mean, do we stay at 4% if that's where the Fed says they're going to go? And what does that do to earnings estimates? And that's really the question for a lot of stocks.
Just what a move. Sam Stovall, happy to say, joined us now, Chief Investment Strategist at CFRA. Sam, can we just start with the big drawdown? Can we call it that yesterday, the aggressive sell-off? Did you pick up the pieces this morning, Sam? How do you approach a sell-off like the one we had yesterday?
Well, I would approach it the way Tom seems to be approaching it. That is, when life gives you lemons, make whiskey sours. So basically, you look to history that, history tells us that whenever we have had a 4% one-day decline, that we usually see a bounce of about 1% the day after. That's happened about 2 out of every 3 times. But then we sort of trade sideways for the next week as well as the next month before resuming an uptrend 3 months down the road. So basically, I think investors just have to hold on to their hats right now.
Sam, I've been dying to talk to you about a concept I heard maybe 10 days ago, which is a lot of good ideas out there in common stocks, but you can't get scale. You can't buy a countable number of stocks. Do you at CFRA find that you've got a number of good ideas and then it's hard to find other good ideas?
Well, I think what you're finding is that as time goes on, you find that there are fewer and fewer companies on which you have solid conviction, because what our analysts do is they're looking 6 to 12 months down the road. They're not really looking for the next couple of weeks. And so, yeah, they take a look at the change in economic projections, in earnings forecasts, look also at momentum, and sometimes that list tends to get trimmed as a result. But we still have a solid count of stocks that we regard as being 5-star or strong buys.
Sam, how do you reject this idea that we're going to see an earnings decline that has not yet been priced in? This is what Wei Li of BlackRock was saying, and this is what Mike Wilson of Morgan Stanley has put out there, that basically what the bond market is reflecting is work that the Fed is going to do that will essentially crimp the activity of a lot of companies.
Well, I think it's a logical assumption that that's going to happen. Traditionally, in bear markets associated with recessions since World War II, we've seen a 1/3 trimming of the PE ratios. But since the market tends to anticipate the end of recessions by almost 2 full quarters, we have to, in a sense, wait 2 more quarters into the bull market before we get a trough in earnings. Right now, we've already seen reductions in estimates. Q3 earnings are now expected to be up 4.2%, but on June 30th, they were expected to be higher by 10.5%. In terms of 2022 and 23 estimates, now we're looking at 6.8% for this year versus 8.9 at the end of June, and next year 7.4% growth versus 8.8. So we're already seeing a reduction in forecasts.
Sam, I'd love to squeeze this in, just a little bit more of a sector focus as Lisa digs a bit deeper. Financials. It was a big call at the start of the year. Yields are going up, rates are climbing, get into the banks. Hasn't worked out. Energy now in focus for a lot of people. This Fed is set to crush growth. That's the fear that a lot of people have if they're going to carry on hiking interest rates by 75, 75, 75. Do I want to be long energy? Do I want to be long financials, given the expectations we've got off the back of that CPI report?
Well, historically, what you find is that consumer discretionary, technology, and financials are underperformers in a hefty inflationary environment, which is what we saw back in the 1970s. We are looking at financials that are trading at a slight discount to their long-term PE ratio, so about 5% discount, whereas energy is trading at a 55% discount to its average PE over the last 20 plus years. So I would tend to say things are done more on a relative basis. And right now, on a relative basis, investors are gravitating toward the defensive consumer staples, utilities, as well as the inflation hedges of energy and, to a lesser extent, materials.
Sam Stovall, thank you, sir, as CFRA. The other one we've heard recently as well, Lisa, is the small caps, off the back of the concerns around the FX story and the weakness abroad.
That basically the domestic strength is going to uphold some of the stocks that have gotten most beaten up until now. I think that that's also the reason why it's a valuation story. If you read Lori Calvasino over at RBC basically saying they've already seen so much pain, perhaps there's some value.
What did Marcus Ashworth say yesterday about foreign central banks after that print? We literally got the inflation print, quickly shifted towards talking about the Federal Reserve and the market fallout. And then, Tom, Marcus Ashworth sat in that seat and he said, this is the worst news for other central banks and the rest of the world.
I agree. Well, the rest of the world's a key thing here. I'm enough old school where I'm worried about Ecuador. I'm worried about 1992 of Mexico and any number of other items of the past. There is a certitude now that EM is different this time. I don't buy it for a minute. I check every morning, Thai baht, Philippine peso, all the rest of it. And you never know where it's going to be. You can think as hard as you want, and you never get it right about which is going to snap.
Tom, how are you thinking about how much work those central banks in EM have already done to hike interest rates and try and stabilize the situation they've got domestically?
Well, they don't have a dual mandate. They've got a fourple mandate. And the fourple mandate, let's take Indonesia, is the people of Indonesia, a ginormous nation, odd OPEC energy, in betweenness there. And I'm sorry, mostly it's a social mandate that we don't hear from the Western banks.
You've got the debt issues on the one hand, and then folded into that, you've got the FX dynamic as well. And that's really what Marcus was speaking to yesterday. Not just an EM problem. Don't know if you want to call that an EM central bank around the corner on Threadneedle Street. I'll allow you to do that. Governor Bailey's a little bit too close this week. Might avoid that one just in case I see him as I walk out the door. It's a conversation I don't want to have, but other people are having it.
Well, and the question is whether it's the Fed's world and they're just living in it and they have no say, really, even if they do raise rates sufficient to match the Fed. And that's certainly what we've been seeing in the currency pairs.
Tom, what's coming up next? Glenn Youngkin, Republican from Virginia. What do you want to discuss with Glenn?
The politics of America. We had these 3 primaries yesterday, New Hampshire and others, and now what for his Republican Party?
Do you want to squeeze some carried interest loophole stuff in there?
I was going to say, we'll talk private equity. I'm not going to, but it would be interesting.
Equity's down a 10th from London. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China is facing its biggest drop in oil demand in more than 3 decades. According to the International Energy Agency, Chinese demand will decline by 2.7% this year. Now, much of that is blamed on restrictions imposed as part of China's COVID-0 policy. Ukrainian troops are keeping pressure up on retreating Russian forces. Ukraine's border guard services said the army has now retaken a town just 2 miles from Russia that was seized on the first day of the war. Russian troops have been seen withdrawing toward Moscow-controlled Crimea. A strike set for Friday could prevent American railroads from transporting farm products and other key goods, and it could cost the U.S. economy $2 billion a day. President Biden is personally trying to break the logjam between railroads and labor unions. Labor Secretary Marty Walsh will meet with railroad and union representatives today. And Google has lost most of the first round in its fight to overturn the EU's record $4.3 billion antitrust fine. Judges upheld the vast majority of the European Commission's arguments, but they cut the fine to $4.1 billion. Google is accused of imposing unlawful restrictions on manufacturers of Android mobile devices and mobile network operators. Hong Kong will quit moving travelers with COVID to isolation hotels or quarantine camps. Instead, they'll be allowed to remain in designated quarantine hotels. That marks another easing in the city's travel policy. The move comes as Hong Kong prepares for several high-profile events, including a summit for global bankers and an international rugby tournament. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When the price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad. And crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg Terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. When U.S. inflation numbers are released,
a stunning inflation report.
Bloomberg brings you crucial data at terminal speed.
Core rises 0.6%. That is double last month.
And instant expert analysis.
There goes Goldilocks.
Republicans are really going to harp on that. This is about a narrative shift in markets.
There clearly isn't going to be a pivot anytime soon.
Sooner or later, they're going to make a policy mistake.
Ouch for America, but double ouch the rest of the world.
Nobody covers the economy like Bloomberg, your global business authority.
If there's any doubt at all about 75, they're definitely going 75. We thought they would be stepping it back to November, to 50 in November. And at this point, you would say 75 is certainly going to be on the table there in November.
And maybe beyond. That was Jay Bryson, the chief economist at Wells Fargo. If you were looking for a bounce this morning, I think we're all looking for a bounce after the losses of yesterday. You're not getting one. It's very small. Briefly negative in the last 30 minutes or so. Right now positive, about 0.1% on the S&P 500, up by 2 or 3 points, only up by 2 or 3 points. Aggressive losses yesterday. The biggest one-day loss, as I've said repeatedly through this morning, and many others have as well. The biggest one-day loss going back to June 2020. Yields are so much higher. Over the last few months, we're up 5 basis points on a 10-year to 346.24. I said coming into this week, we've had 6 consecutive weeks of 10-year yields climbing. It's not just the 10-year, it's the 2-year as well. Lisa, just quickly, where are we on a 2-year? 380?
We were at 380. We're now 381.
381.
Looking at just this incredible rise and then the correlated and commensurate drop in the S&P and the NASDAQ.
The TK, what a move that's been, 380 plus.
Continue to watch it here this morning, and of course data dependent, but certainly watching foreign exchange as an international measure of where we are right now. And this is the most interesting time to speak to the gentleman from Rice University with mechanical engineering as a background. He went on to engineer all sorts of efforts in private equity and venture capital. He's the governor, the Republican from Virginia, Glenn Youngkin, and we're thrilled the governor could join us this morning. Governor, I cannot think of a time to speak to you with someone as pro-business, pro-innovation, dealing with a Republican Party that wants to bomb Rob Portman and the rest back to an anti-business time. How anti-business, anti-Youngkin is your Republican Party?
Well, I don't think the Republican Party is anti-business. And in fact, Republican governors all over the country have been leading the recovery coming out of the pandemic. And that's exactly what we've been doing in Virginia. We've got taxes down. We're open for business. We're seeing great announcements from companies. We have a lot of open jobs. And that's one of our biggest challenges is getting people back to work. I am really concerned about the inflationary policies that we see coming out of the Biden administration. And Tom, we see the ramifications of that yesterday, which is anybody who thought that this was going to be short-lived has been shaken, because what we're seeing is the persistent result of bad policies, inflationary policies with grocery prices up, fuel prices up, and Virginians and Americans feeling it in their wallet, and they're having to make compromises as a result.
We have iconic American companies moving, for instance, from Chicago to Greater Washington, D.C., translated Virginia. We've got entrepreneurial companies such as your announcement today on an innovative company. And on a wage basis, they're competing with Amazon, who's lifting compensation for drivers in hundreds of thousands of their employees. Is there a wage spiral in Virginia?
Well, there is a real wage inflation challenge. These wages are growing, but they're not growing as fast as inflation and the cost of living. I'm really excited about these new companies that are coming, like Plenty Unlimited that we're announcing today, that is going to build the largest indoor growing facility in the world. And we're going to see them right here in Virginia. They're going to compete for talent. This is why we have to get people back into the labor force. We've seen labor participation drop substantially in Virginia. We were up near 67% prior to the pandemic. And unfortunately, we dropped and we're in the 63.5%-ish now. We got to get people back to work. These great jobs, these next generation kinds of opportunities will pull people back into the workforce, but we've got to stop all of the underpinnings that have encouraged them to stay home and out of the workforce and get them back to work.
Governor, this indoor vertical farming company and the indoor vertical farm that you're espousing really speaks to an agenda more commonly associated with the Democrats in terms of trying to make things greener, make things more modern with respect to the carbon footprint. Do you find yourself bumping up against that stereotype when trying to have a more modern approach that brings in more young workers?
Well, not really. I mean, agriculture is Virginia's largest private industry, and technology is one of our fastest growing sectors. And so to bring agriculture and technology together in the Commonwealth of Virginia makes perfect sense. And in fact, we have absolutely become the hub. With today's announcement with Plenty, which is going to build a $300 million facility right outside of Richmond, 300 new jobs, and our announcement 2 days ago with AeroFarm, we will have the first and second largest indoor growing facilities in Virginia. And yesterday we announced another company, Beanstalk, expanding their facilities. So we're bringing together our agriculture roots, our technology future, and forging the way for an industry of the future. Ag tech uses far less natural resources, has higher yields, and a great product. And I just think this is part of the future of agriculture. It's happening right here in Virginia.
Just real quick, Governor, I remember speaking with you when you had your private sector hat on about infrastructure and plans that you were looking for. And I'm wondering now that you're in the public sector, if you've been surprised by the partisanship that prevents certain things from happening, or have you been surprised in the other way?
Well, I do believe that investing in infrastructure broadly is critically important to facilitate growth. I mean, we're seeing capacity issues across our infrastructure. I mean, we're still rated a D as a nation. We got to address this. And so we're doing it in Virginia. We moved up substantially in the rankings at infrastructure. Our port is being deepened and widened. Our road infrastructure is being improved. Our connectivity and broadband is taking a huge step forward. And this is the kind of progress that we must make. We're doing it both with government-led things, but more importantly, with public-private partnerships. And I think investing in infrastructure will continue to be one of the great challenges and the great opportunities for Virginia and the nation.
Lisa, is that one step closer to asking about carried interest? Is that what you wanted to do with the governor next?
Well, we could have gone to carried interest, but we're out of time. So you're in luck.
Governor, I know we had some technical problems to start the interview, so we have run out of time, sir. But next time we'd love a longer conversation. Governor Glenn Youngkin there of Virginia. Governor, thank you. Great to catch up with him.
Yeah, he's a really interesting person. And speaking to him when he was at Carlisle, he was really big on investing in infrastructure.
We didn't have time to get this in, but
Sure.
I think an important conversation with somebody straight talking like Youngkin is okay, but can you find common ground with Democrats with the American disgrace, which is child care? He wants, the usual Republican chit-chat about get people back to work. And yet we're living in the medieval age. It's like Westminster Hall. We're living in the medieval age of childcare in America.
I think that it's a big issue. You want me to comment on that one?
No, I just think it's tangible.
He's been very vocal about education.
We're leaving that there. Future's up, a tenth of 1%. Didn't know where it was going. Live from London.
It's with Tom Keene. What do you want?
This is Bloomberg.
it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Lisa said it's PPI Wednesday, so we're getting some PPI data in a couple of seconds. Futures into that, at 0.2% on the S&P.
58.
Futures 59, just about pushing high. Yields higher as well by 5 basis
56.
Points. With the data, here's Mike McKee.
54.
The numbers are just coming across for producer prices. Final demand on a month-over-month basis falls by 0.1%. And that was what was forecast. The core, though, rises by 0.4. That's more than the 0.3 that was estimated. That's ex-food and energy. With PPI, you also take out trade services, which is basically an equivalent of retailer margins, and you have a 0.2% rise, same as last month, same as forecast. So this leaves us with a final demand year over year at 8.7%. That's down from 9.8%. The core 7.3 down from 7.6, and the core with trade services 5.6 from 5.8. So some significant changes for the better on the PPI side, on the producer price side, contrasting with what we saw on the side of the consumer price index. So maybe everybody can get a little happier today.
Maybe just a little bit, or perhaps not quite. Mike McKee, thank you. Equity futures pushed just a little bit higher, up by 0.2% on the S&P 500. Yield still higher by 5 or 6 basis points. 346.43 on a 10-year. The 2-year still through 380, just about, Bramo. Lisa said it a few hours ago when we opened the show. Basically, this data point was about whether it confirmed your fears about yesterday, and if it didn't, you just ignore it and look ahead to the Fed next week.
I would agree with that. That's basically...
That's what you said 2 hours ago, and that seems to be how the market's moving.
I stand by it.
Should we start the countdown clock to retail sales tomorrow?
Would you like to do that?
23 hours, 58 minutes,
Let's go.
14 seconds.
You should go in the line that's circulating London right now to go and see the Queen, and Just count down
They
to
should.
retail sales. They'll have no idea what you're talking about.
I could stay there for 3 or 4 days. Seriously, a huge queue to see the Queen. We'll bring that to you in the next hour.
It's just crazy.
Yeah, this is really history being made, folks. And please stay with us in the next hour through the weekend and into Monday as well. Right now, and this is really an honor because I can give you a story about how economists become stars. Michelle Meyer is with MasterCard Economics Institute, but far more, one day, a girl fell out of Boston University and everybody stopped and said, wow, does she know housing? Michelle Meyer joins us now after years at Bank of America and truly expert on your next mortgage and rent payment. Michelle, let me cut to the chase. How bad is it? How bad and how persistent will the housing inflation be?
Well, thank you, Tom, for that wonderful intro. I think the big challenge for the housing market right now is simply affordability, and that comes from two factors. One is that home prices increased at an extraordinary rate across the country over the last 2 years, running in double-digit rates for the major metropolitan areas. By our metrics, and we looked at home prices relative to income growth across all of those really specific metro areas, about 65% of the country is considered overvalued. So you have that coupled now with this extraordinary increase of mortgage rates, and that has created a huge shock to the housing market. So as you know, home sales have been falling steadily since the beginning of the year.
Right, multifamily to the rescue. That's what always happens in the cycle. Can multifamily come to the rescue in Nashville or Denver, never to the rescue in New York, but is multifamily, are we getting more units?
We are. We certainly are. I mean, if you look at housing starts, they're still running above what you would consider a break-even rate, particularly for multifamily. And remember the lags with multifamily as well. It takes about a year from the beginning of the project to completion, on average, once the construction starts. So, you had a lot of projects that were ongoing. The development was happening, and now you're starting to see those completions. So you're starting to see those projects enter the market in a bigger way. So you still have supply hitting the market, particularly in the multifamily space. And that should help because you can have some conversion from owning to renting, given the affordability strains in the housing market. But look at owner's equivalent rent in yesterday's report in CPI. That is accelerating further. So there's still rental pressures as well, which further strains affordability across all housing.
What can rate hikes do about that? What can rate hikes do about that rental price pressure we're seeing build?
Well, I would argue that transmission from monetary policy is quite apparent in the housing market right now and will be increasingly in the rental market as well. These are interest-sensitive sectors. And the fact that the Fed is increasing as rapidly as they have, and you'd argue for reasons that are quite clear to contain prices and inflation, that increase in interest rates has slowed down demand of housing. And in turn, it will put that type of downward pressure on home prices as well, on home price appreciation, which then spills into rental inflation. But that all takes time. It is not immediate. But I would argue it's already underway, that transmission.
Well, at least on the housing price side, but on the rental issue, I just want to pick up John's right to bring up the fact that rents are still climbing and faster than people had previously expected, at least based on the CPI report from yesterday. And there's an argument that the higher prices go on houses, the more people are forced to rent, the less affordable it goes, especially given the high mortgage rates. Where is this potential for an overshoot at the same time that the people who are least able to handle inflation are feeling all the more pain?
Yeah, I mean, look, these are certainly some of the challenges here in terms of finding that ultimate equilibrium in the economy after creating, some real imbalances in terms of excess stimulus. And I think, the adjustment is happening, but it's not complete. And in the interim, yes, you've seen this, some push into to renting, which is increasing demand for rentals when there's still some, lag in terms of getting all that supply into the market. But it will come. And frankly, one of the ways it will come in terms of normalizing inflation, normalizing particularly rental inflation, is through the demand side. In the sense of weakening the broader economy, particularly the labor market. You have a bit of an income shock, and then naturally you start to see that feed through. And that's what Fed Chair Powell, I think, has been saying quite clearly, which is that they are keenly focused on price stability and reducing inflation. And that does mean, sacrificing some real growth.
But this really leads to the question of how much pain needs to be inflicted on this economy, or how much pain will be inflicted on this economy based on the rate hiking cycle being priced into the market in a way that we are not anticipating because of that lag time, because we're not seeing it yet in some of the metrics. What's your sense of how likely or unlikely a hard landing, I hate using that, but a recession that's somewhat significant is, given the report that we got yesterday on CPI?
Well, I think the report yesterday showed two things. One is that you are seeing relief on the supply side in that, we've seen a drop in energy prices. We're starting to see some easing of goods inflation and more should come given what you've seen from container costs coming down, supply chain issues easing. But the demand side, there's still a lot of inflation there, and the services economy is feeling that. So for the Fed, that has a lot more control over the demand side, it does give them that type of, push to continue to raise interest rates to cool down the economy. And Lisa, to your point, it is taking time because the starting point was really high. As we've been talking about, as I'm talking to you all for the last few months, the consumer's healthy. There's strong balance sheets. Right. The consumer's still out there spending, and they're navigating this inflation environment.
Okay, Michelle, you've been brilliant on that. And of course, you've got all the resources of MasterCard to figure that out. Jim Glassman at JP Morgan is pushing against the gloom like no one I've ever seen in the decades he's done this. Help us with the Glassman-Meyer consumer. How boomy is the consumer right now?
Look, from our data, we're looking at our spending pulse data for the month of August. There was an acceleration in the year-over-year growth rate of consumer spending. And that's even controlling for these movements in gas and oil and autos, et cetera. So like the underlying demand, that did accelerate. So we'll see what the retail sales report shows tomorrow. But, it seems like we're setting up.
Retail Thursday.
Retail Thursday.
Michelle,
we'll give her credit for it.
Michelle knows it's Retail Thursday.
It's Retail Thursday.
It's MasterCard.
I think it's so important. This is a brutal reality and a brutal fact. James Glassman of JP Morgan and Michelle Meyer over at MasterCard is saying all of this continuum we talk about, the consumer, every seat on the airplane is taken.
Absolutely.
There's a boom.
So let's say that's true. And a lot of people are on board with that view. What they're saying, though, Tom, ultimately is that because things are resilient, the Fed needs to do more. Northman Trader out on Twitter, an account I know you love, he said this: the Fed will break it until we make it. Think about that. Yes, we can talk about the same thing at the same time. The two issues, Tom. You've got a resilient economy, but also that the Fed needs to break some stuff to get inflation down.
Well, the more resilient the economy, the higher inflation will remain unless there's some sort of exogenous event to bring it down. And
some
I think
supply side miraculous story that delivers that soft landing, and we all hope for that.
Right, exactly, which is the reason why there is a narrow path to a soft landing, but it's the reason why people are getting bearish, because things are so resilient. Things are so good for the consumer.
And that's why we're seeing the 2-year yield through 380.
Yeah, which is just sort of shocking.
Onto retail sales.
Actually,
and
just did for a little.
The equity market's got to digest that. It's back to normal.
Yeah,
380.
They're all going to get back to normal, and we're all going to survive.
Thanks, Tom.
That's my,
Is that like...
I'll send you the invoice.
That seems to be the speech from the president yesterday.
No, the speech of the president yesterday was he looked foolish because he did not address the immediate inflation report. He could have scored major points by being presidentially optimistic and note the inflation is crushing a huge part of America.
To him, isn't that his comms team? What are they doing? What were they thinking about
having
a concert-type celebration of the Inflation Reduction Act on a morning like that?
This is a delicate moment, and he's actually done better in the polls over the past few months because of gasoline prices, and now it gets a little trickier.
379.86 on a 2-year. Coming up, as we count you down to the opening bell, Oksana Aronoff of JP Morgan Asset Management, looking forward to that. Zach Griffiths
corn's under $7 a bushel.
Sites, and Samir Samana is joining us from Wells as well. Where are you going with that?
I'm not. I think it's there. The Dow's up 52. Okay. Life goes on.
Do you want to take a break? No? Okay, we'll take one. From London, this is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. European Commission President Ursula von der Leyen laid out plans to raise $140